Hello everyone, I am excited to start this course and I'm very sure that this course is going to be very helpful to you because I have been teaching accounting for a while, so it's very exciting to put this into a real course and help even more people. So let's directly get into the content. So in this first video, I would like to explain some basic terms. So we're thinking of them in the same way. So first of all, we have to talk about something called an asset. What do we mean by an asset? Now, for now, just think of an asset as anything that you own, right? So if I own a laptop, that's my asset. If I own a monitor, that's my asset. If I own a table, that's my asset. So literally anything you own is your asset. So anything that you own. Then let's talk about the second term, which is called a liability. Now, what is a liability? Just think of liabilities as anything that you owe. Anything that you owe. So, for example, if you owe someone money, that's a liability. And obviously, we'll talk about everything related to that. So, don't worry, for now, this definition should be very good. And the last term we should be talking about is called equity. Now for equity, I wouldn't really ask you to worry too much about what it actually means, because it is more important to understand equity mathematically. So think of equity as assets minus liabilities. Means everything someone owns minus everything someone owes, to see how much do they really have remaining for themselves after they pay the liabilities. So that's kind of what equity is. So obviously there are many ways to think about equity. Some people say it is the net worth, which of course is not 100% accurate, but yeah, pretty good way to understand what it is. So that's why for now I'll just say think of equity as assets minus liabilities. Now that we have established what we mean by asset, liability and equity, now we can move on to the next step, which is to understand what we mean by the accounting equation. So let's talk about that. The accounting equation. Believe it or not, understanding this is the most important thing in accounting. This will affect every other topic that you're solving, literally every other topic. So it is absolutely crucial, and you'll see from me explaining that I cover this topic in a very thorough manner. So what is an accounting equation? It basically states that assets are always equal to liabilities plus equity. So let's try to understand that for a second. This means assets, that means everything you own, is always equal to everything you owe, and let's say the money left over after you pay what you owe from the assets. So it actually does make a lot of sense, because if you think about it, right, when a business has an asset, right, it owns something. Either it came through a liability, right, means let's say if you have cash in your asset, you either got it through a liability, right, you borrowed the money, or you got it through equity, means it is your own money as a person or as a company, if you're talking about that. Now you might say, what do you mean by own money? Think about it. When you're a company, owners invest money into the business. Now this money for the business is its own money, it's equity for the business, okay? It's not a liability, because we are not supposed to pay back this money at a certain date in the future. No, this is the money that we have as a business that we can spend however we say fit. So that's kind of what the accounting equation is representing, which makes a lot of sense. Again, just to make sure we understand this, what you own is always equal to what you owe, because either you got the asset through a liability, or you got the asset through something that is actually yours, right? Like again, owner investing money into the business and the business giving shares. So that means that money that the business made by issuing shares, it's its own money, it's not liable to pay it back. So there you go, that's all you have to know about the accounting equation, because now we'll begin a format. This is the format I always use with my students, because this has worked tremendously. So if you notice, the format is basically showing assets are equal to liabilities plus equity. However, under assets, I have mentioned some of the asset accounts, so you get some practice out of this and you understand what's going on. And under liabilities, I mentioned an account called accounts payable, which you'll see a lot of in the future classes. And equity. Under equity, we have three things: capital, we'll talk about what that means, revenues, and expenses. So without any further delay, let's start the concept. But just to explain why we need to understand this format is because this format will help you understand which transactions affect which accounts in what manner. So let's do the first transaction so you see what I mean by this. Let's say owner introduced $100,000 cash into the business. So because if you are doing accounting from the for a business, this is always what happens, right? First, the business needs some money from somewhere. So owner introduces money into the business. So, and also another thing you have to understand, we always do accounting from the business perspective, right? We're not doing accounting from the owner's perspective. You can do that, but again, you're probably not learning accounting to do business, to do accounting for a person. You're doing it to do accounting for a business. So we are going to do accounting from the perspective of the business. So let's think about this. Owner introduced money into the business. So owner gave cash to the business. So for business, the cash will go up. So if you notice, I'm writing a positive 100,000 to suggest it's going up. And since this money is invested by the owner, it is under equity account called capital. Always remember, all of the money or all of the value we get from the owner into the business is capital. So that's the first transaction. So okay, so now we are starting to build some concept here. Okay, when owner puts anything into the business, it increases the capital account, which is just keeps track of how much money was introduced by the, let's say, to keep it simple for now, by the owner. And cash is also increasing, which is increasing by $100,000. Okay, now that's the first transaction. Let's go to the second transaction. And by the way, if what we just did is not 100% clear, it's fine. It's not going to be a problem for us because the strategy that I will adopt to do this course, everything will become clear for sure, right? So don't worry about anything. This is normal when like you don't understand like little bit here, little bit there, but as we go along, you should be able to understand everything. And if let's say after we are done with the many topics and you still don't understand some of the things, then okay, you can look at the course again and like let's say also a third time if you want, and then like it should be like perfect. So let's do the second transaction. So let's say after the owner put money into the business purchased a building for $20,000 cash. Now let's think about it. So we are buying a building, that means our building is going up, right? Because now I own that building, my assets are going up. However, another asset is going down, which is cash, since I'm paying cash. And if you also notice, this seems to always be two accounts affected, which is, by the way, remember, always true. Means it is not possible for a transaction to only affect one account, because we have this account equation, right? Assets are equal to liabilities plus equity. So if it affects one account, it has to affect another account to somehow balance the accounting equation. And it's very logical, you don't have to consciously think about balancing it. That's not a good approach. Just logically think about it. Okay, I purchased a building for cash, what happened? Building went up, cash went down. You'll always get the right answer. Amazing. Let's do the third transaction. Let's say the business purchased a car for $30,000 on credit. Now let me explain that term, credit. Credit means I promise to pay money later. Since I'm buying it on credit, that means I bought the asset and I promise to pay the money later. So what will happen here is my car will go up because I just bought the car, and my accounts payable liability will go up, because accounts payable is the account which shows you how much you owe for, let's say, the things you purchased on credit. So I hope everything's clear so far. It should be. Again, if there's any problem, it will automatically get cleared out. This is a normal process of learning accounting. Let's do the next transaction. Let's say we paid the money back now for the car previously purchased. Okay, so let's think about it. If I'm paying back the money for the car I purchased in the previous transaction, my cash should go down, of course, by how much? 30,000. And my liability should also go down since I've paid the money back now. I'm no longer liable for this amount. So this is how we understand every transaction. Okay, I understand now. When I buy something, this account goes up, this account goes down, or any combination of things. So we have to make sure that we understand the concepts, which accounts are affected in a very good manner, because everything else will become a lot easier if we do that. Okay, let's do the next transactions. Let's say we provided accounting services for $10,000 cash. So let's assume we have a service business, right? We provide service and obviously we make money from that and receive cash. So in this case, what's happening is we provided someone accounting services and they gave us cash for those services. So of course, my cash should go up, but the question is which other account will be affected? So here you have to learn this term called revenue. Revenue refers to the money that you earned. Now, just to give you an introduction, earned doesn't mean you've received the money. Earned means you've done your work. Now you are entitled to that money. If you received it right now or you receive later, that doesn't really matter in you recording the revenue part. Of course, we'll talk about how does it change the cash part, right? If I don't receive the money, of course, it wouldn't affect the cash account. We will talk about that. But remember, the moment you've earned the money means you've done the work for that money, it becomes your revenue. So in this case, our revenue account under equity will go up. Now let's talk about the situation that you might be thinking about. What if it was not cash? Means I did the work and customer will pay me money later. So let's introduce another account into this table called accounts receivable. Now accounts receivable, of course, is the opposite of accounts payable. Accounts payable refers to the money we owe someone else. Accounts receivable is the money customers owe us, right? So in this case, let's take the same transaction but change a little bit of detail there. Let's say we provided accounting services again to someone, let's say for $12,000 worth of money, but on credit, means we did the work and the customer promised to pay later. So in this case, of course, we know the rule. The moment I've done the work, I should record revenue. So my revenue will go up by 12,000. However, cash will not go up since I haven't received the money. So I have to think logically here. Okay, if I'm supposed to receive money later, which account should that affect? Yes, I'm sure you guessed it. It's accounts receivable. Accounts receivable goes up since I am now owed money because of this transaction. So that's kind of what accounts receivable tracks, the money you are owed from customers. Amazing. Let's do another transaction because I'm sure all of this is very logical. Just again, if you're having trouble, just try to rewatch the video and follow along. It should be very easy. It should not give you any problems. Amazing. Now if I say customer paid the money back for the services provided previously. Okay, so now the customer is giving me the money back from this transaction, right? So of course my cash will go up since I'm receiving the money by 12,000 because we know it was 12,000 that the customer owed, and since the customer no longer owes us this money because they just paid, we remove that money from the accounts receivable by subtracting it by 12,000. So that's how do you understand the revenue side of things, right? How does revenue affect different accounts? Now let's do the last thing that I want you to talk about in this format, which is called expenses. So let's say we paid rent expense for this month, let's say, of $5,000 cash. Now we'll again think very logically. Because I'm paying cash, my cash goes down. And since we incurred an expense, our expense will go up. Always remember that the moment you have used an expense, you have to increase the expense account. because we are recording that expense just to keep track of things. That's what accounting is, right? Keeping track of what happened and all the transactions that took place. So these are all the basic transactions I always like to make sure that students understand. And now I'm going to show you something. Let's do the total of each account to show you that accounting equation will balance. If it doesn't balance, that means we have made a mistake, of course, because it's not possible for accounting equation to not balance. Okay, so these are the totals I've done here. And before talking about this part, also I want to add something. In case you don't understand what an expense is basically like, let's say, cost of running the business. Again, by the way, this is like a pattern recognition, you know, like when you see the cost of running business, like rent, utilities, let's say wages, salaries, advertising, like you will get used to like, okay, knowing, okay, that's an expense, right? Like it's never a problem. Like please don't worry about thinking, okay, I will not be able to identify. No, you'll definitely be able to identify which are expenses, because you'll see the same names, right? Rent expense, salary expense, wages expense. So you'll know this is an expense and this is not an expense. Like it's actually quite easy. Now let's see if the accounting equation holds true for this. What is the value of my total assets? Let's calculate that first. Okay. So value of my asset is this plus, and then 0, 0. So 0 I don't have to add here. So assets are worth $117,000. Let's look at liabilities. Liabilities are worth at the moment $0. And let's look at equity. Now, if you notice something, for equity, I am under equity accounts. I'm writing this very hidden formula here. If you can see, capital plus revenues minus expenses is what we mean by equity, which makes sense, right? Like revenues is when you earn money, so you have more, let's talk of it as net worth. Again, not the perfect way, but it will do the trick. So when you earn money, your net worth goes up, and you spend money on cost, right? Like rent and everything, your net worth goes down, because you are now you have less of the value. Okay. With that in mind, with that formula in mind, if I apply this formula, capital plus revenue minus expenses gives you equity. So if you notice, yes, accounting equation does hold true, because my assets are equal to my liabilities plus equity. And that's it. All right. So now that we have completed the discussion on the accounting equation, we are ready to move to the journal entries, which is the part that people seem to think that it's like extremely difficult, it doesn't make sense, but in reality it is extremely easy and it makes a lot of sense. So again, if you don't know what I'm talking about, debits and credits are what we mean by journal entry, right? We have to put debit and credit into different accounts. So let's start that discussion. So just to show you why I am saying this is very easy to do, contrary to popular belief, I guess. So I'll make the format of journal entries, and I'll show you with every transaction, if you understand logically which accounts are affected, which is what we just learned in the accounting equation, debits and credits become a no-brainer. Very easy. So let's do the first transaction. Let's say on 1st of January, owner introduced $100,000 cash into the business. Now, before moving further with this, I would like to show you some rules of journal entry, right? So everything that we're going to do will actually come so much easier. So let me draw some rules for you. So assets, liabilities, and let's say equity. So let's see my drawing skills. All right. Okay, there we go. And let's do the bottom arrow. All right, so copy and paste and paste. Okay, So what do I mean by rules of journal entry? So if you notice, I'll like write some rules here for you, just so I can tell you what this means. There you go. And this will be. So basically, to explain this, like what I mean by all of this is that we have to memorize that when assets increase, they will always be debit. Now you might say, like, why assets increase on debit? Now this is the way the accounting, let's say, structured. The person who came up with this debit and credit approach, right? They had to come up in a manner where debits are equal to the credits. So what I would say is, don't worry about like why this is the rule as much as just memorizing this rule of accounting. Like in accounting language, right? Assets always increase on the debit side. So if you write asset as a debit, that means asset is going up, and assets decrease on credit. But if you notice that the equity and liabilities, the rules are opposite of an asset. Assets increase on debit, however, liabilities and equity increase on credit. Assets decrease on credit, however, liabilities and equity decrease on debit. Now let me just show you the demonstration of why this is the best way to learn journal entries and the correct way to learn journal entries, because nowadays I see many different teachers give like this acronym way or shortcut way, which doesn't really work. Teachers are just trying to make it easy for them to just get through the topic. So I would really encourage you to memorize these rules like in a manner where it becomes a second nature to you. Like throughout the day, keep revising the rules again and again and again and again. In 2-3 days, it will become like very easy to recall, and like your life as an accountant is like far easier. So let me show you what I mean by when I say journal entries are quite easy. So what you're supposed to do is, you're supposed to look at the transaction that you're supposed to make the journal entry for and write the concept down. Again, this is for you. The concept part is just for you to make sure you understand what's going on. So of course we learned that when owner puts money into the business, cash goes up and capital goes up, right? So in the concept I will write cash increase and capital increase. Again, this is just to make sure we are thinking correctly. We know which account is going up and down. Of course, like once you get very good at journal entries, don't write this, right? Because you know things correctly, like we can be sure at that point. But right now, I will encourage you to write the concept just to make sure you know which account is going up or down. And now we have the moment of truth to apply the rules. Let's see. Cash is an asset. An asset goes up on debit. If you notice again, cash is increasing, so asset is going up, and I have to record that asset is going up. Asset will go up always on the debit side, so I have to say on 1st of January, cash is being debited by $100,000. That's all there is to journal entry. Let's do this part. Capital increase. We already discussed capital is a equity account, and if you notice, capital is increasing, so equity increases on the credit side. That's it. We just prepared our first journal entry by only knowing the rules of journal entry and the concept behind which account is going up or down. That's why I said, when you understand the accounting equation like well, everything else in accounting makes sense and becomes easy for you. Again, the problem is nowadays it's treated as one of the topics. It's not just one of the topics. It is the topic to understand the accounting equation. Now that you understand it, I'm making a logical connection to how we are able to do journal entries with those concepts. And again, this is the correct way to do this, not acronym way where you don't get any faster in doing entries and you have so many problems. Please don't take that shortcut, because that might make it easy for one day but difficult for the rest of your life. This will, yes, of course, ask you to memorize for a couple of days to get the rules very well, like in your mind. But for the rest of your life, accounting is not a hassle. You always know what is debit, what is credit. Okay, let's do the second transaction. Let's say on 5th of January, purchased a building for let's say $20,000 cash. Again, let's do the same practice, write the concept just to make sure we understand what's going on here. So since I'm buying the building, my building asset will increase, which is also what we talked about here. Purchasing a building increases the building. And what is the other effect? Since I'm buying the building with cash, my cash will go down. Cash will decrease. So let's add a row there. Amazing. So now again, let's apply the rules to this transaction. Building is an asset, it increases. So let's see the rule. Asset will increase on the debit side. So building will be debit. And cash is an asset, but it's decreasing. Asset will only decrease on the credit side. So cash will be credit. Now this is again the language of accounting. You know, like if you use accounting software and you just tell it cash increase, it wouldn't understand like what do you mean cash increase. But if you say cash debit, it understands that you're trying to say cash is increasing, because in accounting the language is not increase decrease, the language is debit and credit. Increase decrease is for us human beings to understand like what's going on with the transaction, right? So this journal entry is how we record transactions into our accounting system. So if you want to use accounting software and you want to record a transaction, it will ask you to prepare the entry. What is debit, what is credit, means what is increasing and what is decreasing maybe. So let's keep going. I just want to show you this. Accounting is a very easy subject, and like it's not hard, at least in my opinion. Like it shouldn't be hard for anyone unless like of course like you've not learned it in the correct way. So let's say on 10th of January purchased a car for $15,000 on credit. Again the same approach, write the concept. Car account will increase since I'm buying the car, and since I promised to pay money later, which is what on credit means in this case, accounts payable increases, which we also talked about in the previous topic, the account equation. Now again, if you apply the rules, car is an asset, asset increases on the debit, so car will be debit, and accounts payable is the liability, and liabilities increase on the credit side since it's increasing, so accounts payable will be credit. So I hope you're seeing like if you just understand the transaction effect, you always know the entry. It's not possible for you to know the effect and not know the entry. This just never happens. So I hope this helps you realize like you have to work on the basics like in a very good way. Then everything else like you can like have some like freedom in. Let's say, and before doing that, let me also explain something else. If you notice, I'm always putting the debit item before the credit item. If you ask like, is that necessary? Yes. That is actually a, let's say, a rule in accounting to put the debit before the credit. Why that's the case? There's no reason. It's just the way it is, you know. So always put the debit before the credit. If you're giving accounting exam, that's a necessity. If you're using accounting software, it's also a necessity, because even if you make the correct entry but you write credit then debit, accounting software doesn't really understand like what you mean, you know. So it gives you an error. So always write the debit before the credit. Again, a very easy thing to get used to. All right, let's do the next transaction. Let's say on 12th of January, we paid the money back for the car previously purchased. Now what's going on here? So here, since I'm paying back the money, my cash will decrease. And since I'm paying back the owed money, so that means if I pay it back, I no longer owe the money, my accounts payable will also decrease. So again, magically we apply the rules and we'll get the correct entry. Let's see. Cash decrease, cash is an asset, asset decrease on credit. So credit, we always know we have to write like this after the debit. So let's write in the bottom area here. And then accounts payable decrease, which is a liability, decrease on debit. So accounts payable, debit. So magically we now understand how we come up with the journal entries, because again, it's not rocket science. It's like extremely easy thing to manage, you know. So I hope this is making sense. So like I will keep it here for this video, and I'll like in the next video, of course, I'll continue. So you like get a little bit of break in between learning all of the things we are learning. Okay, so let's continue on our discussion. So we obviously talked about when you pay the money back for something you previously purchased. How do you account for that? Again, everything is very logical. Nothing should be again a problem for us. So let's do another type of transaction, because I'm sure for now like you're following me, and if you're having any problems, again rewatch the video. It will again make things Clear. So let's say on 14th of January, we provided as a business accounting services for $10,000 cash. So we have an accounting business, we provided services of accounting and customer gave us cash. So my cash will increase, again we know from the concepts, and since we earned money, means we did the work, my revenue will increase. So again, literally we just apply the rules and we should be very good here. So cash increase, cash is an asset, so cash is debit, and revenue increase, revenue is always under equity, so revenue will increase on the credit side. Now here I want to add another point. So again, like we are going to make accounting so easy, like it's going to be perfect. So if you notice, like I'm mentioning revenue, which is amazing, like this is the correct way to do accounting. But if you think about it, if my manager comes up to me and says, Shaheen, tell me how much revenue I made from services and how much revenue I made from sales, because you have to realize businesses don't just make money through services, they make money through sales as well. So I want there to be two separate accounts for separate revenues, right? So this is why we always specify the name of the kind of revenue. So in this case, we will say service revenue. Again, even if you just say revenue, it's fine, it's not wrong. But if you say service revenue, like that's perfect. There's literally nothing else you can do to make it better. That's amazing, right? So yeah, that's one point I will mention there. So that applies to everyone. You're like preparing for an exam or like you're doing real life accounting, please keep that in mind. Okay. Next one, if I say on 16th of January, we again provided accounting services, but this time not for cash. For let's say $15,000 on credit. That means the customer promised to pay money later. So again, we'll think logically, okay, have I done the work? Yes. And we know the moment we have done the work, it is revenue. That's always the case. But am I receiving the money? No. Will I receive money later? Yes. So if you receive money later, that's called accounts receivable increase, which is an asset, by the way. And just in case you're thinking why accounts receivable is an asset, so let me give you that explanation also in this case. Now, if you think about it, accounts receivable is the money that you actually own, which is just in someone else's hands, right? Because that's the logic, right? If I've done the work for someone and they owe you money, means there is some money in the world you own, but you don't have it with you right now. It's just in someone else's hands. So that's why accounts receivable is also an asset, because it represents the money you own, but it's just in someone else's hands. So let's do the entry. So 16th of January, it will be accounts receivable debit because it's an asset increase on debit, and revenue credit, but we learned that in revenue we should always specify. So service revenue increase. Amazing. All right. Let's do the next transaction. Let's say on 18th of January, customer paid the money back for the services provided previously. Now, in this case, we will again think about this logically. Okay, if the customer is giving me the money back, my cash will go up. And since I'm no longer owed this money, my accounts receivable account will go down. So if we make the entry, cash is an asset, increase on debit, so cash debit, and accounts receivable as an asset, but it's decreasing, so it's credit. So I hope you're seeing the utilities of the rules. If you the better you know the rules, the faster you'll get at this process. And just to let you know, like, it gets to a point where you are consciously thinking about this. You're thinking about like something else that happened in the day, and you're still making the entries as a student or as an accountant. So it's like actually a very good way to learn accounting. Now, a last transaction that I would really encourage you to know about. Let's say on 20th of January, paid rent expense of $8,000, let's say cash. So conceptually, we know what will happen here. Cash will go down since I'm paying money, and my rent expense will increase. Again, you might say, why are we not just calling it expense? Because again, expenses in business are many different types. There's a rent expense, the advertisement expense, salary. So it is better to specify which expense happened, again just to keep track of things separately, right? So just to make it clear, for revenues and expenses we should always specify. For assets we already have separate account for everything, you know, everything is already specified automatically, right? This is cash, this is car, so we don't have to worry about that. So let's apply the rules here. So cash is decreasing, which is credit, of course, but let's think about rent expense. Now when we talked about expense, we also learned a formula under equity, right? We said formula for equity is capital plus revenue, so that means capital and revenue both increase equity, and minus expense means whatever expense happens, it always decreases the value of equity. Now if you can follow that logic, you understand that since expense decreases equity, equity decreases on the debit side, so rent expense will be debit. But if that didn't make sense to you, I will also give you another way to think about this. So when we learned these rules of journal entry, let me mention that name, rules of journal entry, I will make a separate rule for expenses, because I know from experience from teaching that if you have separate rules for expenses and you think of it as a separate thing, life becomes a bit easier, which is always what we want, right? We'll want to make things as easy as possible. There you go. So now you have like separate rules for expenses, so now you can memorize all of the rules in a separate way, right? Expenses increase on debit, decrease on credit. Again, why do expenses increase on debit? If you want to know, again, because it decreases equity, which is debit. Again, don't worry about that complication, just memorize the rules separately and you should be very good to like solve everything. And yeah, this actually, I can think of one more transaction I would also add here, just to make everything complete. Like, so after this video, you are very good with the journal entries, and of course, like then we'll move on to the next topic and next topic. Let's say on 22nd of January, made sales of $30,000 cash. Okay, so we already discussed making money through service. Now we are making money through sales. So our cash will increase, since of course we are receiving money for the sale, and our revenue will increase since we are earning money. But which revenue? We always specify, in this case, sales revenue will increase. So entry will be again very logical, applying the rules. So it will be cash debit and sales revenue credit, since it increases equity and equity increases on the credit side. Finished. I hope you're seeing accounting is very easy. I know I keep saying that again and again because I hear this all the time. Accounting doesn't make sense. It's difficult. No, this is one of the easiest subjects you can actually get into, unless you're getting into advanced accounting, which is also easy when you understand everything well, by the way, just to let you know. So accounting is not complicated if you understand the concepts, the basics well. If you don't understand the basics well, then accounting is almost impossible, like at least to get to advanced level. It's like very difficult. So I'll leave it there. In the next video, of course, we'll cover the next topic. Hello everybody, so we are back. So we have already covered the basic terms, what they mean, the accounting equation. I hope you realize the importance of that part to understand which account goes up or down in which transactions, because that really builds the base that you need to have to be great at every other topic we're going to learn. So we already covered the journal entries, and hopefully you saw that it's actually not random to do journal entries. It's actually very logical, right? If you understand which account is going up and down, we are just literally applying the rules of accounting journal entry into recording them. So now we have the step that comes after recording the journal entries, which is the T accounts. So let's go to our journal entries. I'm going to show you here. You know what, I'm just going to make a duplicate of this sheet just in case we also need to see this again in the future. So let's make a duplicate. There we go. Okay, so now we have a duplicate file and the original entries, just in case we need the original ones. Okay, so I'm going to remove all of the transactions here so I can show you how do we make the T accounts. So by now I will guess that you have taken some time and have been able to get the rules memorized. So I'm going to remove this. All right. Now, let's talk about the topic of T accounts. What are T accounts? Why do we need them? And everything like that. So, if you're learning accounting for a exam, let me first delete this. Sorry. There you go. Okay. So, if you're learning accounting for an exam, you have to understand T account in this way. So, first of all, let me put the entire accounting cycle that we are going to cover here, so I can like teach you in the best of ways. There we go. So what is the first thing we learned in accounting? Accounting equation. Then we learned journal entries. Now just to make sure, until that, like what we're doing, accounting equation just helps you understand transactions effect on different accounts. Journal entries are how we actually record transactions into the accounting system, right? Again, by accounting system, I mean an accounting software and things like that. After journal entries, now again, if you're a student, right, this is a good concept to have. So after journal entries, there is still a possibility, right? Like a manager can come up to me and say, okay, Shaheen, I understand that you have recorded everything into the accounting system, but I need to know the total of each account rather than just how much you recorded for each account, right? So obviously we are recording, let's say I'm debiting cash, crediting cash, and they just want to see the total cash I have at this point in time. How will I tell them how much cash we have? That's where the T accounts come into play. T accounts are how we calculate the ending balances of the account, means the total of each account. Now nowadays, just to let you know, if you're learning accounting for a business, T accounts are done automatically. So you don't have to actually do them manually. But if you're a student, this part will be actually very helpful to do T accounts. And even if you're doing it for your business, learning for business, I think it still gives you some value to learn how to do T accounts. So you understand the logic behind that. So to make a T account, we'll simply draw a T. There you go. So we have to make a T account for each account because I need to find the total balances of each account by the end of the year. And why do I need to do that? Because if we go further in our accounting cycle, so we will learn the accounting equation, journal entries, T accounts, and there will be more things until we will also make the financial statements like income statement to calculate the profit, balance sheet to report on the assets, liabilities and equity. We'll talk about that, don't worry at the moment. But just to let you know, we do need to know the total balances at the end of the year so we can make those reports that we are supposed to make for a certain period of accounting time. Okay, so let's calculate cash. How do you do this? Now again, this is called the T accounts, and these are also referred to as the ledger accounts. It's always good to know all of the terms we use. Alright, so if you're doing a cash T account or any T account, all you have to understand is we basically look at the journal entry. For example, because I'm making the cash T account, I'll look at the journal entry and see if cash is affected. In the first one, yes, cash is affected. Is cash a debit or credit? So cash is debit, so we will put the cash on the debit side. Yes, left side is the debit side, right side is the credit side. That's always how accounting works. So in this case, I'll write 1st of January, we debited $100,000 in cash. So this side is the debit side and this right side is the credit side. Okay, second transaction. Now in this case, a cash is a credit. So on the credit side, I'll write $20,000. And what is the date? It's 5th of January. Awesome. Third one, is there cash? No. Fourth one, is there cash? Yes. It's a credit again. So I'll do the cash credit again by 15,000 and the date will be 12th of January. Perfect. Then on 14th of January, we are receiving cash, means cash debit. So on the debit side, I will write 10,000 and 14th of January. So yeah, it's as simple as this. So here, is there cash account affected? No. In this one, is there cash account affected? Yes, cash is debited by 15,000. So 15,000, and the date was 18th of January. All right. Then we have a cash credit on 20th of January. So let's do that. So 8,000 cash credit on 20th of January. Awesome. And now we have the final one. The cash is on the debit side in the 22nd of January. So we can write 22nd of January. I think it was, how much was? 30,000. Okay, $30,000. So now we have posted all of the journal entries into the T account, and yes, that's what it's called actually. So this is called posting journal entries into the T account, means putting the journal entries into the T accounts. Now, this is where we'll do the calculation of the total we have now after all of the transactions have been posted. So we'll calculate the ending balance. Again, that's what it means to find the total. Basically, to find ending balance, it's always the total increase minus the total decrease. So we know cash is a asset account, and assets increase on debit. So that means I have to do the total on the debit side minus the total on the credit side, because that's the decrease side. So just to repeat that again, to find the ending balance, we do the total of the increase side minus the total of the decrease side. So in this case, total of this side minus total of this side. If I press enter, I just found out how much total cash I have after I've been through all of these transactions. Now, like we said, you need to make this T account for each of the accounts separately, because I do need to know how much of each account I have. It's not just cash. So let's make more accounts, but the good strategy is always to first count, okay, how many accounts am I going to need? Okay, so we are going to need a capital account. Okay, let's write it here. So one account for capital, building account, one account for building, car account, so one account for car. Then we have accounts payable, one account for accounts payable. Then service revenue, we also have to make an account for service revenue. Accounts receivable, okay. And then rent expense and sales revenue. So rent expense and sales revenue. Amazing. So if we count this out, we need 8 more accounts. So let me delete this. Why did I count this here? So first we can just make a format of all of the 8 accounts and then start solving, like that will be very efficient way to do this. So I've made a T account. I'll literally copy and paste it 8 times, right? We already made one, so I guess 7 times more. So 1, 2, 3, and let's do it on this side now. 4, 5. Oh, I guess I misclicked somewhere. Okay, anyways. 5, 6, 7. Or did I miscount? Let me double check. So 1, 2, 3, 4, 5, 6, 7, 8. Okay, that's fine. Like we are already with enough accounts. Okay, so let's name each of the account, right? So here we'll make the capital account. So let's just fill every account in, then just go by one. So we have capital account. Again, let's do the same thing. We look at the capital account. Is it being credited, debited? Credited. So on the credit side, we will write $100,000, and the date is on 1st of January. Now, any other capital effect in any other entry? No. So that means that is the only posting of a journal entry into the capital account, which is usually the case, by the way. Cash is only the account that's affected the most, you know. It again debit, credit, debit, credit, credit, debit. It's just it just keeps going. But every other account is very short. So in this case, we will calculate the ending balance, which will be credits minus the debit, right? Total of the credit side minus the debit side. Since capital is the equity account, it increases on credit, decreases on debit. So in this case, we will do the sum of the credit side. Apparently it's just 100,000, and minus the sum on the debit side, which is of course 0. There's nothing there. So ending balance is 100,000. And you might notice, like, I'm always writing the ending balance on the increase side, and yes, that's a generally accepted way to do the total ending balance. Now, if you are learning accounting in a country where IFRS is used, you can like write the ending balance on the other side, the opposite side, just to let you know, a decrease side, just to balance it out. Yeah, so just as an information, you normally put the ending balance on the increase side, but in IFRS, International Financial Reporting Standards, which is what most of the world uses, you'll put the ending balance on the decrease side. A small detail, it doesn't really make a difference, it's like where everything is. Okay, in any case, we'll go to the third account, which is called the building. Let's do building. So now I'm going to pick up some pace. So because we have built up the basics, so 20,000 debit, 5th of January, 20,000 debit, 5th of January. Is there anything else about building? I don't think so. So that's it. So we'll do ending balance, which will be 20,000. All right. Next one, we have accounts payable. Okay. Accounts payable. So we have a accounts payable credit 15,000, credit 15,000, and it was of 10th of January. Okay, then debit 15,000 on 12th January. Okay. After that, do we have any more of accounts payable, or that's it? Yeah, I think that's it. So in this case, ending balance is 0. Because the total credit minus the total of the debit side is 0. After accounts payable, we have a service revenue account, I guess. Oh, I think we did not do the car account. Oh, sorry, let's do the car account. Okay, my mistake. There we go. So, for car, it's just 15,000 debit, and I guess that's all. So, 15,000 on the debit side, and it was which date? 10th of January. So very simple, we just keep going with the same approach, and you should not have any problems with these T accounts. After car and accounts payable, we have service revenue. So let's do that. Service revenue. All right, so service revenue is being credited by 10,000 14th of January. So 14th of January, 10,000 credit. Awesome. Let's keep going. Any other service revenue? Yes. Again, 15,000 credit, 16th of January. All right. Oh, sorry, it's 15,000, not 10,000. Let me write 15,000. Okay. Any other service revenue? No, we have sales revenue, but not the service revenue. So let's do the ending balance of service revenue, which is 25,000, of course. All right. After service revenue, which account do we have to make? Accounts receivable. And in case you're wondering, do I have to follow a sequence? No, you don't have to follow a sequence because it doesn't really change anything. But again, if your teacher is saying follow a certain sequence, if you're given an exam, sure, go for it. Like some teachers say, like write the asset T accounts first, then the liabilities, then equity. So if that's the case, do it. But yeah, generally it doesn't really matter at all. So accounts receivable. So we have a debit 15,000. 15,000 debit. It was on 16th of January, I believe. Let's see. Yep. And then accounts receivable credit again 15,000 on 18th of January. 18th of January. Is there anything else on accounts receivable? I don't think so. Okay, so that means accounts receivable also has an ending balance of 0. All right. Some weird things going on here. Accounts payable and accounts receivable are 0. Of course, that's fine because we are that's the real balance. But yeah, I guess unconsciously I will put the debit and credit as equal amounts in the entry. Okay. So we are pretty good so far. After accounts receivable, what account do we have? Rent expense. Okay, rent expense. So rent expense is only one-time debit to 8,020 January. So 8,020 January, let's do that. So ending balance is 8,020 January. Okay, and the last account is sales revenue. I know you must be tired, so this is a great thing to that this topic is coming to an end. Okay, so sales revenue we have on the credit side, how much? 30 grand. So $30,000. And what is the date? 22nd of January. All right. Now the ending balance is, of course, 30,000. And that's all there is to T accounts. We just calculated the total of each account that we have. For example, total in cash, we have this, total in capital, we have that, and so on and so on. So we literally found out the total balance we have in each account. So in the next video, we'll talk about the next part of the accounting cycle, which is a trial balance. Okay, so let's continue on. So in the accounting cycle, this is called the accounting cycle because it's showing us basically what we do. Like first we do this, then this, then this, then that. So after we know the totals of each account, which is what the accounts showed us, we will prepare something called unadjusted trial balance. Now you might be wondering, what do we mean by unadjusted? For now, don't worry about it. Let's just learn how to do the trial balance, and then when we move on to the next part of the accounting cycle, you'll understand why we called this an unadjusted trial balance. Okay, so let's continue on the same worksheet. So we did the journal entries. From the journal entries, we did the T accounts. Now from the T accounts, we are going to make something called a trial balance. But of course, this is the unadjusted trial balance we are supposed to make. But let me write a definition for you what a trial balance is. So basically, the idea is like I want to have a summary list which will show me the ending balances of all of the accounts. Like I shouldn't have to have all of these T accounts in a printed pieces of paper, so it's like 5 pages long. You know, I've ending balance, like I check everything. And also for normal people, like they don't understand what T accounts are, right? So to make it simple, we create a summary list where we show the ending balances of each account. So it's like very easy for everyone to know how much of each account we have. So this is basically list of the closing or ending balances of all accounts. Now let me show you how it is made. We literally just create 3-column format. Let me just do it right there. And again, if you're doing this for your business, this part is also done automatically. But if you're a student, of course, you learn how to do this part. So description, debit and credit, this is what the the trial balance looks like. So now all we have to do is we have to go to each T account and write their name and write how much we have in the ending balance. So cash we have is 112,000. So we'll write here cash 112,000. Now if you notice, I'm writing on the debit side. So yes, this is a rule in accounting. Always write the ending balance on the increase side where the account increases, or we can literally just see in the T account it's already on the debit side. So just follow the pattern rather than thinking logically and being a little bit slower, right? For capital, we'll do on the credit side 100,000. So capital 100,000 credit, building 20,000 debit. So building 20,000 debit, and then we have accounts payable 0 credit. You don't have to write it, but let's write it anyways just to make it complete, because 0, right? It doesn't really matter if we mention it or not. Okay, car 15,000 debit, car 15,000 debit, and then service revenue 25,000 credit, service revenue 25,000 credit, Again, I'm literally just putting in on the increase side where the account increases. Accounts receivable we have now, which apparently is 0 since we have already received all of the money we were supposed to receive. Rent expense is a debit of $8,000, and I think the last account, sales revenue, $30,000 credit. Now this is the moment of truth. What will happen is we will do the total on the debit side and the total on the credit side after we have recorded all of the ending balances. If you notice, the debit total is equal to the credit total, which is what we always want to see. Please remember, if you've done your accounting correctly, the totals on the debit side and credit side of the trial balance will be equal. So this is a good way to see, if you've got something wrong. If they're not equal, you have to go back and check where you went wrong. Now, if you're thinking about, okay, is it possible to have a equal trial balance even if I made a mistake? Yes, it is possible. There's some kinds of mistakes that trial balance doesn't detect, but that's not our concern at the moment. We just have to know a basic idea. Trial balance should always balance. If it does balance, it's probably you have not made a mistake, unless again the mistake is of the form that it doesn't detect. So yeah, that's all there's to the trial balance. And yes, we just learned the unadjusted trial balance. Just to keep that in mind, unadjusted trial balance we learned. So in the next video, of course, we'll continue on with the accounting cycle. Now we are going to talk about the next step in the accounting cycle after we have already completed the accounting equation. Again, that's just so you understand the concepts. We've done the journal entries, means recorded the transactions into the actual accounting system, then done the T accounts to find the totals of each account. By the way, T accounts are usually made at the end of the accounting period, which is usually a year, or it can also be every 6 months. But you understand, at the end of the year, you create the T accounts so you can make the unadjusted trial balance, and then you can make the next one and the next one. So all of these things except the journal entries happen at the end of the year, or again at the end of the accounting period rather, because it can also be 6 monthly accounting period or quarterly accounting period depending on the size of the business and everything like that. Okay, so the next step that we have to cover is called the adjusting entries. Now, just to give you a good understanding of this topic. Now, if there's any topic that there have been the most students that I've had, always confused about, it is the adjusting entries. The reason I'm telling you this, so you understand the significance of this topic. Students say it doesn't make sense, but of course it makes sense. Otherwise, why would it be into accounting, and why would accountants know how to do it, right? Of course it makes sense. So the problem usually is when people don't understand the adjusting entry, they probably don't understand some of the previous things, right? Maybe the rules of journal entries, debit and credit, they've not memorized correctly. Maybe they don't understand the effects of each account with certain transactions. So there is some other problem with their understanding, not that adjusting entries are actually that difficult. So just to give you that idea, please, for this topic, when we go through the material, please solve what I'm solving again and again and again. Just go through the concept again and again and again, just to make sure this topic is definitely dialed in, right? We know what we're doing here. So just a small discussion there based on experience, right? So don't treat this topic as every other topic, because this is where students get the most problems usually. So before anything about the adjusting entries, we do need to talk about some basic terms first, so we can understand what we do in the adjusting entries. Okay, so there's something called prepaid expense that you have to understand what that means. So prepaid expense is exactly what the name suggests. Prepaid expense means expense that is paid before it is used, right? Prepaid is paid beforehand. So any expense that is paid in advance. So usually in real life, insurance is a prepaid expense, right? Because of course we have to pay ahead of time. But obviously you can pay any expense ahead of time. You can pay rent ahead of time. You can pay salaries ahead of time. So it can arise from any situation. So you have to understand that prepaid expense is basically any expense that is paid in advance. But the problem comes when we talk about the type of account it is. Is it an expense account, asset account, liability account, equity account, or revenue account, which again you can say falls under equity, but yeah. So, and by the way, like from now on, I will really encourage you to think of 5 categories separately. Just to tell you something from my experience, think of expense, assets, liabilities, equity, and revenue as separate categories, because it will really help you out in the later parts of accounting. So just like trust me on that. Okay. Now, prepaid expense, what kind of account is that? So let's think about this. I have paid expense in advance. So is that my expense? No, because you have to understand that in accounting, we only record expenses when they've actually been used. So in this case, I've only paid the money. I haven't used the expense, right? So let me get you introduced to a certain concept. This is called accrual basis of accounting. So what does accrual basis of accounting mean? Please remember, nowadays we use accrual basis of accounting. It basically means that revenues should only be recorded when earned, means when you have done the work, and expenses should only be recorded when incurred, means when you've used them, not when you pay the money. So if you notice, there's no mention about money. It's just revenue is recorded when you do the work, expenses are recorded when you use them. Why is this a great rule of doing accounting? Because this helps us keep everything so accurate, you know. So I only record something when it actually happens, rather than when I, you know, pay the money or receive the money, which is never, like, sometimes not the same at the same time. So hopefully that idea is clear, that nowadays we do accounting based on the principle that revenues should be recorded only when you've done the work, means earned, and expenses should only be recorded when you've used them. So, and by the way, that's what incurred word means, you've used them. Okay. So in this case, we of course haven't used the expense that we paid for. We paid for in advance. So think of it in this sense. So when you pay for an expense in advance, you are buying a benefit for the future that you own. Think about that again. Prepaid expense is a benefit you have purchased for the future that you own now. And what do we call anything that you own? An asset. I never said asset is anything physical that you own. I said asset is anything you own. So even if we own this benefit, it's a asset. So in this case, this is an asset account. So I hope you can see why students get like a little bit confused. They see the name, the word expense in the name, and they think, okay, it's an expense account. No. It's an asset account. Okay. Let's see how the normal journal entry looks like. Again, by the way, we're not doing the adjusting entry, just the normal journal entry. How will I record this transaction into my system when I pay for something in advance? So let's do it a little bit here. So let's say on 1st of January, paid rent expense for 6 months in advance of, let's say, how much money did we pay? Let's say $6,000. Why not? So on 1st of January, to make the entry, again we have to go to our concept, because if you know the concept, you will always know the entry. That's like, I hope that's established by now. So since I'm paying money, my cash will decrease, and since I'm buying up an asset, means a benefit for the future, my prepaid expense account will increase, because now I own this asset because of this transaction. Asset increase on the debit side, so prepaid expense will be debit. In this case, prepaid rent expense will be debit, and cash will be credit. Again, just applying the normal rules we already learned. So I'm building on that if you know the concept, you know the entry. It's never possible to know the entry and know the concept. So yeah, that's what a prepaid expense is, when you paid for an expense in advance. Okay. The second term I want you to get familiar with is something called unearned revenue. Now what is unearned revenue? So unearned revenue is when customer has paid us the money but we haven't done the work. That means customer has paid the money in advance, right? Customer has paid us as the business the money, but we have not provided the services or the sales that we're supposed to do yet. Now here we have to again ask the same question. What type of account is unearned revenue? So if I have received the money but I haven't done the work, if I haven't done the work, I cannot actually say this is a revenue account, because revenue is only recorded when you do the work. So think of it this way. When you receive money but you still have to do the work, this means you owe work to the customer, right? You still have to do the work for the customer. You owe the work. So anything we owe is called a liability. So it's, again, we are bringing everything together, so everything is logical. There's nothing in accounting that you should just memorize, other than of course the rules. Rules are like rules, right? You cannot like try to understand the rule. Again, if you want, you can, like, that's extra work for you, but it doesn't really add anything, at least in this case. Okay, so let's do the journal entry, how it looks like. Again, just to show you, it's very logical. So let's say again on 1st of January, for some reason I always write 1st of January, everything seems to happen on 1st of January. So let's say on 1st of January, customer paid $10,000 cash in advance for next 15 month service. So now, okay, let's think about the concept first. Since I'm receiving the money, my cash will increase, of course. And since I haven't done the work, I cannot record the revenue, but I can record unearned revenue account increase, which is a liability account. It's not a revenue account, it's a liability account. So cash is an asset, it increases on debit. So that part I'm assuming is clear by now, why the cash is debit. And unearned revenue, it's a liability, so it will increase on the credit side. The better you understand the rules, you try to memorize the rules at home, the better it will be. Again, I will give you the same warning I gave you at the start of the course. Don't use the acronym way of memorizing the rules. Please, it's not worth it in the long run. Memorize them as a normal, anything normal that we memorize, right? We don't try to use shortcuts unless, again, we're trying to be over efficient and do that. But I hope you get the point. So that's the journal entry. Again, we're just learning the normal journal entries of these different concepts. Okay. So once we have covered the prepaid expense and unearned revenue concept, we have the third thing to talk about, something called accrued expense. And just to make you ready, like, we have to just talk about 4 of these different concepts. We have already covered 2. This is the third one, and then we'll do one more after this. So accrued expense is exact opposite of a prepaid expense. In prepaid expense, we have paid money, but we haven't used the expense. Here, we have incurred the expense, means used the expense, but we have not paid the money. So let's think about it. If I've used the expense and I haven't paid the money, that means I owe the money. And when you owe money, it's always a liability account. So, yeah. Just remember, accrued expense is a liability account, since we still have to pay the money for the expense we already incurred. So what does the entry look like? So let me give you an example. So let's say by 31st of December, incurred rent expense of $5,000, means let's say we lived in the building for that month, but we have not paid the money yet. Okay. So of course, one thing is clear. I have used the expense, and the rule of accrual basis of accounting was expenses should be recorded when they've been used. So in this case, one thing is a no-brainer. My rent expense will go up. That always has to be a, always will be the case, right? There's no exception to this. When you use the expense, you record expense. The question is, what is the other account that will be affected? So let's think about this logically. I haven't paid the money. Now, just to let you know, if you're thinking accrued rent expense, you are correct. We can call it that, right? We can say accrued rent expense increase, which is a liability account. This is the correct way to do this. This is not wrong. But if you are doing accounting in a let's say US or Canada, you are supposed to write rent payable rather than accrued rent. The reason is just, again, when you say accrued rent, most people would not know what that means, right? So we are trying to use a name that's like more acceptable, more understandable for most people. So rather than saying accrued rent expense increase, we will say, again, by the way, accrued rent expense increase is the correct thing to say. You can make the entry with that. It's accepted all over the world, except again in the US and Canada, usually they say use the one rent payable to suggest what's actually going on in an easier way. So I hope you get the point. It's not a necessity to do it this way unless you are in US or Canada. So rent expense will be debit because we know expense increases on debit, and rent payable, which is a liability, will increase on credit. So yeah, I hope you got the point why I'm not using the accrued expense name, which is completely fine. You can use it, but rent payable is for usually when you are in the US, and again I keep saying the same thing. So I hope you get the point. All right. The last concept that I need you to understand before we get to the actual adjusting entries is something called accrued revenue. Now, accrued revenue is opposite of unearned revenue, just like accrued expense is opposite of prepaid expense. So in unearned revenue, customer has paid money, but we have not done the work. Here, we have done the work, we have provided the service or the sale, but we have not received the money yet. So this is kind of like what we have already done in a way. So I will show you what I mean by this. So if I say by 31st December, let's say we provided accounting services of $10,000, but we have not received the money yet. This is something we have already done, where we said, do you remember? We said, because we have done the work, our revenue will increase, service revenue will increase, and since I'm still owed the money, my accounts receivable will increase because I'm owed more money because of this transaction. So accounts receivable debit, service revenue credit, this is what we already covered in the past classes, but at least now we have a name to give this type of transaction, accrued revenue. And that's it for all of the basic, let's say, concepts I wanted you to know before going to the adjusting entries. Just in case you're wondering what is accrued revenue, what type of account is accrued revenue, it's an asset account because that's what accounts receivable is, right? It's the amount we are supposed to receive in the future. And again, you can use accrued revenue word in every other country other than US and Canada. There you use, probably you should use accounts receivable, so it's more acceptable to the, let's say, understandable for most people. Again, there you go. Done. I'll see you in the next video. We'll continue with the adjusting entries, and hopefully you'll see why people find it so confusing. You've already seen most of it, like these concepts. When you don't understand these concepts well, the next part we are about to cover obviously becomes quite difficult. So let's continue on with the adjusting entries. Obviously in the last video we talked about the basic concepts like prepaid expense, unearned revenue, accrued expense and accrued revenue, and I did tell you that this is a topic that students find a little bit difficult because obviously you have to have a base if you want to understand it correctly. So we have established a very strong foundation, and I hope everything that we have covered so far makes sense. So now let's directly jump into the adjusting entries. Okay, so now we are going to learn the actual adjusting entries. So let's write that, adjusting entries. Now, first of all, let me help you understand what adjusting entries are. You know what? I'm directly going to jump into it. I think that's the best way to teach this. So without me explaining first, let's learn it. Then I'll explain it, because at that point you'll already know kind of what adjusting entries are. So let's directly jump into that. So let's make the format for entries. Okay, so what I'm going to do is I'm going to take the first transaction as we made it already. So let's copy this, and I'm going to ask you to think about something here. Okay, now let's say
we are doing accounting for a company, and at the start of the year, this is the entry we recorded when we paid rent expense for 6 months in advance. Okay, now you have to understand another thing, that at the end of each accounting period, the company has to prepare financial statements, right? And they come from, obviously, the journal entries and the trial balance that you've already prepared. So here, when we talk about prepaid rent, let's assume I record this and I don't do anything else. I just recorded the money I paid in advance as prepaid rent asset. And what will happen is, at the end of the year, when I prepare my reports like the income statement, balance sheet, the prepaid rent of 6,000 will show in my balance sheet under the asset section. However, if you think about it, it should not show prepaid rent as 6,000 by the end of this year. Why? Because we paid rent for 6 months in advance. It would have been used by then, right? So that's why, to adjust the account balance to where it should be, we will prepare something called an adjusting entry at the end of the accounting period. So let's think about this logically. What should I do to make my accounting records correct? So first, obviously we know, since I paid money in advance, but by the end of the year I have used it all already, so my prepaid rent account should decrease, because this 6,000 as a prepaid doesn't exist anymore. I have used it all. And we also learned a principle which is called accrual basis of accounting, that says the moment you have used an expense, you should record the expense. So in this case, we'll say rent expense will increase. So assuming it's a yearly accounting period, which is the normal case, so at 31st of December, the accountant will again apply the rules of journal entry to what's happening here. We want rent expense to increase, so rent expense debit. How much have we used? All of it. And prepaid rent credit by all of it. Why credit? Because it's an asset account, it decreases on credit. So that's the first adjusting entry we just learned. I hope it made sense. Adjusting entries is not a topic that is actually confusing. It's just like you need a little bit more of understanding of the basics and why we need to do this. So now think about this, right? If accountant debited prepaid rent and credited prepaid rent, now the prepaid rent has a zero balance, which is the correct balance because by the end of the year we have used it, right? So when we prepare the reports now, the balance sheet will no longer show the prepaid rent of 6,000. It will show prepaid rent of 0, which is the correct number. So that's what the prepaid adjusting entry looks like. Now let me take another situation just in case you're wondering about that. So let me copy the same normal journal entry here, but rather than saying it was for 6 months, let's say it was for 15 months. So I can show you, like, even if we don't use it all, how to do the entry. Sorry, here we go. All right, no worries, I'll try it again. Okay, so first entry will be the same to record the payment, right? Let's assume we paid 6,000 for 15 months in advance. Now by the end of the year, we'll make the adjusting entry. Again, the same concept. I have to think about how much prepaid no longer exists because I would have used it by then, right? By the end of the year. So again, we'll say, since I've used the expense, my rent expense will increase. And since I have to decrease some of the prepaid expense account, my prepaid rent expense will decrease. Now, when we make the adjusting entry itself, again we'll do the same thing, rent expense debit and prepaid rent credit, but not with the full amount. Because remember, in this example, 6,000 we paid for 15 months. By the end of the year, we would have only used 12 months from January to December. So I have to take out like how much of 6,000 will belong to those 12 months. So the formula is very simple. Total amount divided by number of months that it was supposed to cover times by how much we used. So I hope you already have a good understanding of mathematics, right? Because this is like literally a very basic way of converting a number into a portion of it. So there we go, 4800. And that's again the adjusting entry for prepaid expense. I just wanted to show you post situations. It doesn't really matter because concept is same. At the end of the accounting period, you just imagine what should I do to make my accounting correct. If prepaid expense has been used, of course it has to decrease at the end of the accounting period. So I will assume that you'll review this again and keep practicing. In the meantime, now I will obviously move on to the next thing for which we have to learn adjusting entry, which is the unearned revenue. So again, to save some time, I will copy the normal entry from unearned revenue from the example we already solved, which is a great example. There we go. Now here I'll again mention the same logic. Now think about it. On 1st of January, we recorded a unearned revenue liability of $10,000. And let's say I don't do anything as an accountant. I just recorded this when I paid the money. When I received the money. And I don't do anything. By the end of the year, when people are reviewing my balance sheet, they will see a liability of unearned revenue at $10,000. But should they be seeing unearned revenue liability of $10,000? Of course not. They should see the remaining unearned revenue, because by the end of the year, I would have done some of the work, because this money we received for 15 months of work. And by the end of the year, we can assume we would have done 12 months of work. So we have to make an adjusting entry at the end of the accounting period to make this correction. So we'll think again logically. Because you have done the work, now it's your revenue, because that's what we talked about. Revenue should be recorded when earned, means when you've done the work. So here we'll say service revenue, since this money was for services, will increase, and the unearned revenue account will decrease, since some of the unearned revenue has now been earned, right? It's no longer unearned. Okay. So let's make the adjusting entry here. So adjusting entry would be, in this case, unearned revenue debit, because the liability decreases on debit. And by how much? Again, let's do same thing. 10,000 is for the full 15 months. So 10,000 divided by 15 times by 12, because we only would have used 12 months of worth of, we only would have done 12 months worth of work by the end of the year. There you go. And that's the adjusting entry for unearned revenue. I think I forgot to write the service revenue. There you go. Okay. So that's the adjusting entry for unearned revenue. I hope that made sense. Now, if I try to think about what might still be bothering you, okay, you might be thinking, what if it's the middle of the year kind of situation? I received the money, let's say, during the year, and then at the end of the year, how would I do the adjusting entry? Okay, so literally the same idea. So let me copy the same example, just change the date, right? So I can show you what would you do. Let's assume this was the initial entry when we paid when we received the money, of course. So let's assume the date that we received this money was not on 1st of January. Let's assume it was on 1st of August. So let me change the date here as well. So let's assume we recorded this on 1st of August. Okay. Now again, adjusting entry, we will use the same logic. By the end of the year, I would have done some of the work. So service revenue will increase. And by the end of the year, since I've done some of the work, my unearned revenue will decrease, because it's no longer unearned. I've done some of the work from this amount. So entry will be, or rather I should say adjusting entry would be, unearned revenue debit by how much? In this case, 10,000 divided by 15 times it by how many months did we do the work? August, September, October, November, December. 5 months. So times it by 5. So service revenue credit, again just following our basic journal entry rules. And we are done with the unearned revenue adjusting entry. I hope again here also everything is clear, because it should be. This is all concept, right? It's all understanding. There's nothing you should try to memorize, like you should conceptually understand what's happening here, why the adjusting entries are needed. So now if I go back to this part, so we covered the adjusting entry for prepaid expense, we covered the adjusting entry for unearned revenue, obviously in the different sheet, and now we have two things remaining: accrued expense and accrued revenue. So what I'm going to do is I'm going to copy both of these to the sheet we are working on, and I'll show you something. Copy, and let's go down. There we go. Paste. Oh, let me paste it on the other end. Here we go. Okay, much better. All right. Now, what if I told you that the entry for accrued expense we learned is actually not a normal journal entry? It is already directly an adjusting entry. I don't know if you picked up on the detail that I said by 31st of December this happened. Incurred rent, but we have not paid the money. So please remember, for accrued expense, there's no such thing as a normal entry and then adjusting entry. No, it's directly an adjusting entry. We directly record it at the end of the accounting period, right? So for accrued expense, the entry we learned, which we thought was a normal entry, it is not a normal journal entry. It is an adjusting entry because this is made at the end of the accounting period. Similarly, the accrued revenue is also directly an adjusting entry. However, of course, you can make it during the year as well, by the way. I mean, of course, when customer owes you money, you have to make it during the year as well. So this entry we also use during the year and at the end of the year as well, when we have to do this at the end of the year. Because if you're giving an exam, you'll see a situation like, for example, by the end of the year, we already had done work worth $2,000, but we haven't received the money for that work. That's called an accrued revenue adjusting entry, because I have to record that to make my accounting records correct for this year when I make the reports. If I don't record that 2,000 worth of work I've done, my revenue will be understated. So that's kind of the reasoning why you have to record an adjusting entry for accrued revenue as well. And also there's also normally you can also record it during the year, accrued revenue as well, because of course during the year it can also happen you do the work, you haven't paid you haven't received the money, and now you might be saying, like, can't I do other things also during the year? I mean, you can. Like, let's say you are doing accounting and you are making adjusting entries monthly. You can do that. You can make monthly adjusting entries. But the problem with that is it doesn't help with anything. Like, you're not like improving on anything, because if you make adjusting entries every month or at the end of the year, the financial reports, financial statements will show the same numbers. So accountants say, why bother making monthly journal adjusting entries when you can just get away with the year end or accounting period end adjusting entries. I hope all of that was clear, and in the next video we'll talk about some extra adjusting entries that you should know about at least. So let's talk about those basic adjusting entries you should also be aware of on top of what we already covered, but the concepts will remain the same, so it would be very easy for you to understand what I mean by all of the things I'm about to mention. Okay, so there's another thing that you'll face in adjusting entries. For example, one of them would be supplies. So just to explain, what do we mean by supplies? So supplies in accounting obviously refers to, let's say, stapler, the printing paper, all of these small things that you cannot record individually by their own name because they are very low value assets. So we just call them supplies. So if I say on 5th of January, purchased supplies for $14,000 cash. So if you think logically, if I buy my supplies will increase, right? Like we have learned, anything you buy, it obviously goes up. You have more of it now. And since I paid cash, my cash will decrease. And again, if we apply the our journal entry understanding of the rules, we will know what is debit, what is credit. I'll just write it down. By now, I'll assume you've already done enough practice. So when I do debit credit, you know why I'm doing this. Now what will happen is, by the end of the year, something like this would, some information like this would be available. Let's say by 31st December, office supplies worth $2,000 remained on hand. Means by the end of the year, only $2,000 worth of supplies were still with us, right? Everything else we've already used. So why am I saying that we have to make an adjusting entry for this? Is because we realize by the end of the year, we don't have all of the supplies remaining that we recorded initially. I have to remove some of them that I've used. So obviously, if you buy 14,000, assuming there's no, before this year any supplies, we didn't have any supplies. So in this year, we bought 14,000 supplies, and at the end of the year, 2,000 are left. That means we can assume we used 12,000 worth of them, right? If you buy 14,000, remaining is 2,000, that means you used 12,000 worth of supplies. So again, let's think logically, since I've used the supplies, my supplies asset will go down. And because I've used the supplies, I have to record a supplies expense. Because whenever we have used an asset like prepaid rent, it becomes a expense. It's no longer our asset. It's no longer something we own. It's something we've already used. It's a cost of running the business. Okay. So here we'll write 31 December. We'll say supplies expense debit. So let me also mention that supplies expense debit, and supplies will be credit. So that's the entry you need to understand for supplies, the adjusting entry for supplies. Now you might say, why did I use like the name supplies? Why didn't you say office supplies? You can do that. Yeah, if you want, use the name office supplies. No one will ever mind, right? So when you're talking about doing for the exam, you shouldn't be worried about if I say supplies, office supplies. General guideline: if your teacher is saying office supplies word, call it office supplies. If your teacher calls it supplies, call it supplies. Doesn't really matter. Both mean the same thing. Your teacher is probably a CPA or obviously an accountant, so it wouldn't really matter. So that's one of the adjusting entries I thought you should know. And another one I will tell you that you should be aware of, which is, for example, there will be something, there's an adjusting entry for inventory shrinkage. Now, just to explain to you what inventory means, I think if I'm not mistaken, we already talked about that, right? Also, just to make sure. Okay, so we haven't talked about inventory. So in this case, yeah, let me explain again here. So inventory basically refers to anything that the business sells. So for example, if I have a business of selling calculators, calculators are inventory for me. If I have a business of selling cars, cars are inventory for me. So inventory is whatever you have a business of selling. So what will happen is, you will be given a value. For example, let's say, first let's do the purchase entry, right? Purchased inventory for $12,000 cash. The normal journal entry for this would be inventory debit and cash credit. Again, we are assuming situation when there's no beginning inventory, right? At the start of the year, we don't have any inventory from before. And let me also give a date so you see the correct way to do this. So on 1 February, of course, we'll make this entry. However, at the end of the year, you might be given this information. If you're required to do adjusted entries, you will be given this information. By 31st December, inventory, let's say worth $4,000 remained in stock. So if you buy inventory worth 12,000, right, and inventory only worth 4,000 remained in stock, what happened? Obviously, we lost the other $8,000 value in our inventory. Assuming we did not sell any inventory, assuming that we just bought it, put it into our, let's say, warehouse, and then at the end of the year we counted, and it was only 4,000 of it was only remaining. So this is called inventory shrinkage. Now the value $4,000 might be because someone stole the inventory, only 4,000 is remaining, or maybe our inventory got damaged, right? And that's why the actual value of inventory went from 12,000 to 4,000. So many reasons why inventory shrinkage can happen, but those are like the normal ones. So obviously, if my inventory value is going down, my inventory account will decrease. I have to decrease it, right? I have to adjust it. And since we lost value, this is a expense. Which expense should I record? Just increase the cost of goods sold expense for this amount. I hope you know why I'm saying 8,000, because you bought 12,000, remaining is 4,000. Assuming we did not sell any inventory, it should have still been 12,000 of it. But maybe someone stole the inventory, or maybe it got damaged and it's worth less money now than we originally bought it for. So inventory. And I would say, yeah, if you understand all of these entries that we have learned, the adjusting entries, the normal journal entry and adjusting entries, you are pretty good. You have a very good foundation here. Now, of course, in accounting, there are vast topics, right? Every topic you learn, for that topic you learn an adjusting entry, a normal entry. So you everything will be far smoother now if you understand these basic ideas. Well, so if we go to our accounting cycle, now we've also covered the adjusting entries. Now, what comes after adjusting entries? Something called the adjusted trial balance. Because if you notice, we already learned the unadjusted trial balance, so now we're learning adjusted trial balance.
So just a little story, like I actually already completed the course, and now I realized that this file was missing for some reason. Maybe I forgot to copy and paste. So in any case, I'm just re-recording this topic, so let's get into it. So this topic is obviously adjusted trial balance. So I want to show you how you can prepare the adjusted trial balance after you have prepared the adjusting entries. So as we know, the accounting cycle goes like this. You make the journal entries. From the journal entries, the T account. From the T account, the unadjusted trial balance, which is this one, by the way. And from unadjusted trial balance, we prepare the adjusting entry. And after the adjusting entries, now we can prepare the adjusted trial balance. So let me show you how to make it. Very easy to do so. It's just like you have to understand like small concepts here. Adjusted trial balance. So let's make our format. Okay, so just to let you know, now in these adjusting entries are like, there's no transaction to them. I assume these are the adjusting entries, okay? You have to assume these are adjusting entries. So I can show you how you can have a unadjusted trial balance, and then you prepare any adjusting entries that the question requires, and then you get to the adjusted trial balance. So these are, I just assume these adjusting entries, okay? Obviously it will be according to whatever question you have. Okay.
So in this case, first of all, we will look at the first account. Let me take this down and make it a bit larger. There we go. Okay. So to go from unadjusted to the adjusted, it's pretty simple. You look at the account, first one is cash, 19,600. And you have to see if it's affected in the adjusting entry. Is cash affected in the adjusting entry? No. That means the balance is already correct. It's already an adjusted balance because there's no adjustment for it in the adjusting entries. Prepaid insurance, we have 4,500. But if you look at the adjusting entry, we are decreasing it by 2,000. How do I know it's a decrease? Because we talked about prepaid expense is an asset account, and if it's credit, it means it's decreasing. So if I already have 4,500 and then I decrease it by 2,000, the remaining balance in the prepaid insurance account would be 2,500. And that's what we have to do. We have to look at each account and see if it's affected, see each account, see if it's affected. So supplies, is supplies affected in the adjusting entries? No, because there's no mention of supplies. We just copy paste, right? Nothing to change. Same with land, building. So I hope you're noticing, like, we are looking at each one account and then we are checking if it's affected. If it's not affected, we are literally writing the same balance. If it is affected, then we are making the adjustment for the effect and then writing the final balance there. Okay, after building, we have equipment, which is 16,000. There we go. Accounts payable, which is 4,500, since again in the adjusting entries these are not affected. Unearned rent revenue. Okay, unearned, let me write again, unearned rent revenue. So let's see, is rent revenue affected? Debit, it's a liability, so debit means it's decreasing. So if originally I had 4,600 and then I decreased it by 1,000, that means remaining balance will be 3,600. So then we have mortgage payable. Let's do that one. Mortgage payable, 60,000. If you haven't seen some of these accounts, like ignore it, right? Like every liability is like same, right? If I say not every liability is same, all of these liabilities are same. If I say rent payable, salaries payable, utilities payable, mortgage payable, like all of the expense payable are obviously the same thing. So in this case, mortgage payable, it can also be loan payable. All of these are liabilities that are treated the same way. Okay, then we have common stock, which amounts to 91,000. Retained earnings, which amount to 9,000. Again, why am I not adjusting? Because these accounts are not adjusted here. So I don't need to worry about changing their balance. They are already adjusted. Dividends, again mention the same number. Rent revenue, this one is affected. If you notice, rent revenue is being credited. That means revenue is going up. So if we already have 76,200 and it's again going up by 1,000, that means the new balance will be, there you go. After this one, rent revenue, we have salaries and wages expense. Salaries and wages expense, which amounts to, in this case, 44,800. And then we have utilities expense. So utilities expense, which amounts to 9,200. And then we have maintenance and repairs expense. Repairs expense, which is 3,600. Now I hope you realize that for utilities expense, we do have a effect here. So me writing the same number as this is actually a mistake. So what do I have to do? I have to take the unadjusted balance, which is 9,200, and adjust it for what happened here. It got debited. We know expense, when it debits, it means it's increasing. So we'll do plus 900. Now we have the correct adjusted balance for the utilities expense. Okay. Now a couple of things for you to know. Now we've done the most of the part, right? But this last step remaining that I will always tell you to make this a habit for you yourself, to like make never make mistakes in this topic. So what you want to do is, once you have like done all of the accounts there, now you have to check, okay, which adjusting entry accounts are not present here. Means we didn't have any balance in those accounts. Insurance expense, do we have insurance expense? No. So that means we can assume insurance expense probably has a zero, or definitely has a zero balance. That's why it's not shown here, right? So if insurance expense had a zero balance and then I debited it by 2000, now I have to mention it because it's worth some amount, 2000 debt. So I hope that's clear. When an account is not mentioned, that means that account is zero. So when you are adjusting it for whatever the effect in the adjusting entry it had, just record it with that amount. And prepaid, we already did that. We already have that account, right? Where was the prepaid we recorded? There we go. Okay. Then unearned rent revenue, we also already have that. Rent revenue, we also have that. Utilities expense, we also have that there. Utilities payable, we don't have. So utilities payable, we have to mention ourselves. Again, the logic is, if it was not present, that means we can assume it was zero, and since it's being credited and it's a liability, it will increase on the credit side. So we have to increase it by 900, so now it has a 900 balance. Now this is where the moment of truth comes. Now you need to do the total of the debit side and credit side. If you solve it correctly, both will be the same number. Let's see. Yes, there you go. And that's how you solve the adjusted trial balance. Done. So I hope you understood how do we go from the unadjusted trial balance to the adjusted trial balance, and you saw the importance of adjusting entries to help you get there. Let's talk about the next step in the accounting cycle, which is called the financial statements. Now this is what we mean by financial reports that we make at the end of the accounting period. These are called financial statements because they help us understand the financial performance and the financial position of a business. Obviously you can have this for companies, sole trader, you can also have this for partnership if you want. So those are called financial statements. So for example, to give you more overview of what these are, so let me just write some things down so we at least get started on a very good way. Okay, so financial statements, if I had to define these, I would say these are structured reports. Okay, so which financial statements are there? First, we have something called the income statement, which is also called statement of profit or loss in some countries. So what does income statement tell us? So income statement reports the profit of a business by showing the revenues and expenses. Because I hope you understand that profit is basically revenues minus expenses. So of course, if you show revenues and expenses and you subtract them, you get profit. So that's what income statement tells us. It tells us the profit of a business, which obviously refers to the financial performance. It doesn't tell you the financial position, means right now financially how are we doing with regards to what we have and everything. So we'll talk about that just now. Okay, so let's talk about that. So second financial statement is called the balance sheet. This is where we report assets, liabilities, and equity of a business. Now this balance sheet actually tells us the financial position of a business, because if you know what someone owns and what that person owes, you actually are understanding how they are doing financially at that point in time, right? So let's assume there's a person, right? If a person has assets, because it applies to everything, right? If it applies to company, it also applies to a person. Let's say a person has assets of 100, let's say $1,000, and they have liabilities of $20,000. Now, if I ask you, how well do you think this person is doing? You'll say, yeah, this person's pretty well off. right? Because they have how much more in assets than liabilities? 80,000, which means they are in a comfortable financial position. However, if we change the numbers a little bit, and rather than these numbers, I change the numbers to, for example, let's say assets are 100,000, liabilities are, let's say, 110,000. That means equity will be minus 10,000, which by the way is possible. If you haven't seen it, don't worry about it. I'm just trying to make a point here. So now this person, you'll say, is in a horrible position. Even if I give it some like better terms, let's say liabilities are only 80,000. I'm saying only, obviously this is quite a bit, and equity will be 20,000. Will you say this person has a great financial situation or position? Of course not, right? Because this person is only worth $20,000. But it's also not like really bad. Like it's all right. Like it's all right position to have like $20,000 more in assets than liabilities. So I hope you get the point. When you're a business, you want to see your position, and to see your position, you'll have to look at these three things, not profit. Profit just tells you this year's or this accounting period's performance. I hope that is clear, because now I have to start talking about the third financial statement, something called the cash flow statement. Now, what does cash flow statement tell us? If I already know the profit and asset, liability, equity, what's left? So it reports the cash inflows and cash outflows of a business. Means where the business is getting their money from and where the business is spending their money to. So it is a very helpful thing to see, okay, how much the business is getting from the customers, how much the business is receiving from this area and that area, and where are they spending their money, right? How much are they spending in repaying the loans, how much they are spending in paying the supplier. So it gives you another piece of, let's say, another angle of a company's current goings, right? Like how they are using their money. Are they using their money in a healthy manner or not? So obviously, in the cash flow statement, you learn all of these things. So for now, let's go to the fourth financial statement, which is called statement of retained earnings or statement of changes in equity. Let me use that one to be more thorough. Statement of changes in equity. So this one basically reports the changes in equity from start of the accounting period to the end of the accounting period, or rather I should say until the end of the accounting period. Because I hope you understand that equity is a very important number. Again, you can think of it as net worth, but it's not very accurate. But okay, for now let's assume it's net worth, right? Because it's very close to that. So I would want to know like what caused my net worth to go up or down during this accounting period, which is what I will use the statement of changes in equity for, because it will show me start of the year, this thing happened, and that's the final number because of those things. So very helpful thing to have for your business. So yeah, these are the four financial statements that you will need to learn, and yeah, I hope everything was clear. Obviously, I'll see you in the next video. Okay, so let's talk about the first financial statement, which is obviously called the income statement. So let's see what that is. Now, we already discussed that income statement is a financial statement which reports the profit of a business. So if you want to look at the profit of any company, you will obviously could go to their income statement. Now, what does the format look like? That is actually why we're here and covering in this video. Now, before going to the formats, you have to understand that there are two types of income statement. Just so everything's clear and you're aware of all of the possibilities. So first one is called single step income statement. Single step income statement. And the other one is called multi-step income statement. There you go. Now, just to explain what this means. So when you are a service business, you will probably need a single step income statement because you're just providing a service. To calculate profit is very easy. It's just revenue minus expenses, and then you get the profit and everything. So it's like quite easy format. So let me show you what it actually looks like. The single step income statement. Let me just write everything in capital to make it efficient. Okay, there you go. So single step income statement, like we said, is for a service business, a business that, let's say, has a business of providing accounting services, hotel services, like cleaning services, whatever it might be, you know. So the format goes something like this. So first we mention the service revenue that we generated from the business, and then we subtract all of the operating expenses. Now, what do we mean by operating expenses? I'll get to that in a moment. First, I'll lay down the format for you. And we are already at profit before tax. Of course, you probably know after that we have to charge the tax on it, income tax expense, and then we get the final answer called net income, or you can also call it net profit, which is the final profit the business generated after paying taxes. Now, if you look at it, the format is actually quite simple. Okay, so I take the service revenue, money I earn from the main service that I do, minus operating expenses. So let me explain what operating expenses mean. Operating expenses. So operating expenses basically mean expenses that are incurred, means they happen in running the business. So these are essential expenses that you obviously incur to run the business. Like, okay, if I want to have a business, I have to pay rent, I have to, you know, rent out the space, I have to pay salaries, I have to have an insurance, and like all of these things that you do to run the business, those are called operating expenses. So you'll get used to the names if you're learning it for an exam. The more questions you solve, you'll get used to the names. Okay, this is always operating and this is the only non-operating. But just to let you know, so you have a great idea, other than interest expense, almost every expense you'll see will be the operating expense. So that I hope makes things a little bit easier for you. Now, why is interest expense not an operating expense? Because interest expense happens because you borrow money, and borrowing money is not a necessity to run a business. You know, it was a choice. You have made a decision to take a loan, and then that's why you have to pay interest on that money. So if you notice, first we do service revenue minus operating expenses to get the operating income. Now this is a very crucial number because it shows you how much profit you made from the main business itself without considering any side things, you know. So obviously, to make the format a little bit easier, I just said minus interest expense. But if you want to make it absolutely perfectly clear, let me mention it this way, so there's no confusion. There you go. So just to explain what I mean by this. So after the operating income, now we plus all of the other income. Let's say I have a rental property, I made some money from there. I have some money in the savings account, I made some interest on that money. Like all of the other income means revenue you are generating not from the main business but from any side things. And also other expenses have to be added and subtracted, right? If it's an income, of course you'll add the number. And if it's a expense, you'll subtract the number, which in accounting is represented by a parenthesis. So I hope this is clear. X refers to other income as a positive, and a parenthesis X refers to other expenses, means negative. You have to subtract that. Okay. So after we find out the profit from the business, then we add and subtract all of the other side things. So we get our profit before tax. So if you don't consider tax, how much profit did you actually generate? Then you subtract the income tax on that profit, and then you get the net profit. This is the profit you take with you after paying taxes. This is the real profit you actually made. Now, just to highlight the importance of operating income, again, you don't need to know what I'm about to say for like solving purposes, but it's good to know conceptually. We always want to know the profit of a business from its main operations, because on the side things like you can get lucky, you made a lot of money this year, you might lose next year, but we have to understand the main business. Is the main business generating income, means profit, or are they not generating profit? Because if the main business is losing money and on the side we are making money, so in the end we are making good profit, this is not a good sign for the business. It's just a good sign of like investment strategies. Probably the business should close down and they should just do the side things, just make that money. So yeah, that's kind of what the single step income statement is. And now in the next video we'll talk about the multi-step income statement. But just to make one thing clear, when it comes to financial statements, first, before doing anything, memorize the formats. What do I mean by memorize? Like, keep asking yourself, okay, how do I start? Service revenue minus operating expenses, operating income, add and subtract other expenses and other income, right? And then you do profit before tax and income tax expense and net profit or net income. So yeah, that's kind of what I will recommend, is first memorize the formats and then worry about solving questions, because students skip this step. They go right to solving and trying to figure out like if I can solve correctly. Now first make sure the format is clear in your mind, and then you can solve the question and it will be easy. So yeah, that's it. So now let's talk about the second type of income statement, which is called multi-step income statement. So let's talk about that. Okay, I'll just do it on the right side here. So like you can see side by side comparison. Now, first of all, we have to understand which type of business will go for the multi-step income statement. So when you have a business of selling anything, means you don't have a service business, you have a sales business, we use the multi-step income statement. So that's why for almost every company nowadays you see the multi-step income statement format. And even if you are a service company nowadays, even service companies are selling something as well, like, so they are doing both of the things, service and sales. So a accounting business can provide the service and also sell some, let's say, accounting softwares or like some things on the side. So nowadays almost every business has both sales and service components to their business. Like Apple, obviously you can buy iPhones from Apple. They sell iPhones, they sell MacBooks, they sell iPad, but they also provide services, right? Like you can get, they repair your screen and all of the other things that go with that. So nowadays multi-step income statement is almost exclusively what you see in real life, but again, as if you're a student, single step you already know now what that is. So now let's talk about the multi-step or multi-step income statement. There you go. Now here, like we said, assuming you have a sales business, that's when you need this, or you have a sales and service business together, then still you need the multi-step. So the format goes something like this. I'm going to assume that you're a student, so I'm not going to obviously just combine everything. This is not the most advanced course I'm going to make. After this course, I'm going to make another course which is going to be a little bit more advanced than this. So every time we get more advanced, we'll obviously add more components to the format. But for now, you just need to memorize this format. So sales revenue instead of service revenue, and then we subtract cost of goods sold. What is cost of goods sold? I will explain in a moment. First, I'm going to just get the format down here. And when I say less, by the way, less means subtract, right? You don't have to write that, but it's good if you do. All right. Or rather, I'll just say, like I said here, I think this is a very helpful way of showing this. And then profit before tax and everything else is same, because yeah, we already come to the main number we wanted to find. There you go. Okay, so I hope you are seeing it's a little bit longer than a single step income statement, because rather than just doing sales revenue minus operating expenses to find the operating income, we are doing sales revenue minus cost of goods sold. So let me explain what cost of goods sold means. So let's put it like this. Okay, so cost of goods sold. Now cost of goods sold is basically when you sell something. Obviously, we are assuming here you have a sales business, so you're buying things at low price and selling them at a higher price. So let's say you have a retail or wholesale business. So cost of goods sold will be when you sell something, how much you originally purchased that item for. For example, let's say I have a business of selling calculators. So let's say if I purchase a calculator from supplier for $5 and sell it for $12, this means my cost of goods sold will be $5, because to have the product that I just sold, I originally paid $5. So that's kind of what cost of goods sold means. It's just like how much you originally paid for the item you're selling now. So let me remove this here. So I hope that part is clear. Now what we're doing is we're doing sales revenue minus, by the way, sales revenue is the money you made from the sale. In our example, it was $12. And then minus cost of goods sold to see a gross profit. Now gross profit is not the net profit. It's like just like casually if you want to see like how much money I'm making in each sale, you know, how much I make minus how much I buy for. So you're trying to see a quick like image of how much profit you're generating. But of course we know businesses are more complicated than just like paying the original cost and then selling for more money, because you also have to run the business. So you have also have operating expenses. So after gross profit we subtract the operating expenses to find operating income, and then we add, subtract other income. Everything else is same as the single step income statement. And yeah, I hope everything's clear. But just remember, when you're doing financial statements, I'll keep repeating that point, that you have to memorize the format first. Please always do things in a correct way, because if you solve the question directly, okay, you might be able to solve some of the question, you might get like some let's say happiness from that, but my goal here is to make this course the perfect course. That means I need to tell you how to study and what to focus on first and then second, and so on. So yeah, that's all there is to the multi-step income statement, and I hope so far everything's clear. Okay, so now that we have talked about the income statement, let's talk about the second financial statement that we talked about, which is called the balance sheet. So let's talk about that. The balance sheet. Now, this is also referred to as a statement of financial position, just in case you did not know the word balance sheet, which I don't think is the case, but just in case. Okay. Now, we said balance sheet actually reports the assets, liabilities and equity of a business. So, and we also mentioned that it actually reflects the financial position of the business. And while on the other hand, the income statement shows you the financial performance. So for balance sheet, there's no like two types of balance sheet. That's not how balance sheets work. So what you have to do is you have to memorize a format of the balance sheet, and that's it. Like you don't have to worry about which type and what's going on there. Okay. So how does the format look like? First we mentioned the assets, and under assets, now here I will like to give you some guideline. There's a little bit of difference between the format under GAAP and the format of balance sheet under IFRS, which is obviously International Financial Reporting Standards. So as I go along, I'll mention like what the differences are, so you know, like you can memorize the format that is more in line from where you are learning. So let me define some types of assets. So there's two types of categories we have to learn in assets: current assets and non-current assets. So let me define what these are. Now I would say, think of current assets as any asset that can be converted into cash within 1 year. Now saying any asset that can be converted into cash within 1 year is not a 100% accurate way of defining it, but for now I will use this way. So like as we go along, you'll see why I use this way of doing the current assets. So what are the examples of current assets? Now these examples you really do have to remember, like and it will automatically happen, like, or you can like consciously make an effort to always have this in mind, so that it's to speed up the process of becoming like great in accounting. So examples will be cash. It's already money, you know, I can use it within 1 year. accounts receivable. Of course, accounts receivable is the money customers owe you. So if the customer owes you money, probably they will pay you within 1 year, right? So it's not like we're not going to give them more than 1 year to pay, in most cases at least. Inventory obviously is what we sell. So if I have some stock in my warehouse, inventory in my warehouse, of course I'm going to probably sell it within 1 year, right? Or at least try to do that. Now there's one more expense that I will mention, for which this definition doesn't apply. Something called prepaid expense that we talked about earlier. Prepaid expense is an asset where we pay expense in advance. So now here, of course, we are not converting into cash within 1 year. We are using it within 1 year. So if you want, you can think of current assets as assets that can be used within 1 year. I think that should also be very helpful for you. So why don't we write that definition, right? Any asset that can be used within 1 year. So usually again, cash, you can use it right now. Accounts receivable, you'll receive the money within 1 year. That means it has been used. Inventory, you'll sell it within 1 year. And of course, prepaid expense. Normally, we don't pay for more than 1 year in advance of any expense. So that I will say will be a little bit better definition for you. Now we are going to move on to the current asset. So current asset is any asset, non-current asset. Non-current asset is any asset that has a life of more than 1 year. So that means any asset that usually lasts for more than 1 year is a non-current asset. So what would the examples be? Land, of course, land has unlimited life, right? It will be there from now to the end of the world. So we have land, we have buildings usually last for it depends on what kind of structure it is, but it can last from 80 years to 200 years, right? So buildings obviously last for more than 1 year. Furniture, equipment, machinery, vehicle, and so on. These are the common ones I mentioned. Again, it's always good to know the common ones. So the moment you see that in the question, you know this is non-current, right? It makes it a little bit simpler to solve the balance sheet. Okay. Now let's put these into the format of the balance sheet. So first we mention the current assets. If you're following GAAP, if you're following IFRS, first we mention the non-current assets, just to let you know. So I'm going to mention the current assets. So first current asset we will write is cash, then we'll write accounts receivable, then we have inventory, and then prepaid expense. So what I'm trying to do is I'm trying to give you everything I possibly can. I'm telling you these are the 4 examples you'll probably see, right? So you're already good at that. Then if you see something extra, okay, we can manage one little bit of thinking in the question, right? So this will be the total current assets. So let's do that. And now we start our non-current assets, which are also called long-term assets. So here we will have our land, building, and all of these things. So let me just mention. So let's say equipment, land, building, vehicle, furniture, all of the things we talked about. Now, if you're wondering, does the sequence with which I write matter? Now, yes, it does. But first I will say, worry about memorizing the format, not the sequence. So just to give you a general guideline, under US GAAP or any GAAP, let's say, if we are supposed to mention the assets in terms of their liquidity, means how quickly they can be used up. Cash is the most liquid asset, means I can use it literally right now, right? I can buy something literally right now. Accounts receivable a little bit more illiquid, right? Because it takes some time to receive the money. Inventory is a bit more illiquid, and prepaid expenses a little bit more than that. So it's we are mentioning them in terms of liquidity. So that's why here I first put equipment, then I put up if I wanted to follow the guideline, I could have put building here and then a vehicle here, furniture, and you can follow the liquidity pattern. But for now, I again don't want you to focus on the not so important things. First focus on the main thing, which is memorizing the format. But if just in case if it's bothering you, let me write the format in terms of liquidity. Furniture, then we have, let's say, vehicle, building, and then let's say land. And obviously machinery, equipment, whatever comes can come before land. But let me just mention that. I guess maybe since we already talked about it, why don't we do that? Rather, let me make it. There we go. Sorry. So yeah, so now it's perfect. Just in case like it was bothering you, like I don't have it in terms of liquidity. But again, don't focus on that. Focus on trying to master the format. Okay. Once we know the total current assets and total non-current assets, we will combine both of them to get the total assets that we have in our business. So now we're done with the assets part of the balance sheet. Now we'll do the part which is called liabilities and equity. Now if you're doing for accounting for a company, you'll write shareholders equity. But even if you write equity, that doesn't really affect it much. It's just a name, right? There you go. So let's say liabilities and shareholders equity. So in this case, first we're going to mention liabilities. If you are in GAAP, if you are using IFRS, first we write equity, then we write liabilities. So assuming again, because we are using the GAAP format, we'll first do the liabilities. Now in the liabilities we have the, one second, let me correct the spelling. In the liabilities we have the same concept, current liabilities and non-current liabilities. So let me define current liabilities. I think you might already have an idea. Any liability that needs to be satisfied within 1 year. Okay. So that means any liability that you have to like fulfill. Let's say I owe someone money and I have to pay within 2 months. That's a current liability. What are the examples? Like I said, you should always be aware of some examples. Accounts payable, any expense payable that you might have, and unearned revenue can be current and non-current, but for the most part, usually it's a current liability. Then we have the non-current liabilities. These are liabilities that need to be satisfied after 1 year. Means you can take more than 1 year to satisfy these. Any liability that needs to be satisfied after 1 year. Now you might say, what is the example for that? For your level, you just need to know one example of that, which is long-term loan. So the loan you take from a bank, that's the only one you'll probably see in your studies. Okay. So first we mentioned the current liabilities. Oh, sorry, not here. First we mentioned the current liabilities. So under current liabilities, like I said, accounts payable. Then we have any expense payable. I'm saying expense payable, so it can be salaries payable, rent payable, whatever you have in your records. You can have unearned revenue like we talked about, and these are the three I would say are the most likely that you'll see. So total current liabilities, and now we will do the non-current liabilities, which are also called long-term liabilities. So here we should just mention long-term loan, and since that's the only one we're talking about, let's just combine them together and do the total liabilities. But of course, if you want to write like total non-current liabilities, no worries, because it doesn't hurt anything, right? You can do that. It just takes one more step. There we go. And now you can do the total liabilities. So this will be the total, combining the current and non-current elements into the liability. Okay, now we have the final part, which is called shareholders equity. If you're a company, if you're like not a company, if you're just a normal business, let's say you're a sole trader, means you are just one owner, there's no shares, it's not a company, then you can just write owner's equity, right? But in this case, I will show you both ways. For shareholders equity, which accounts will be there? For owner's equity, which accounts you'll probably see. If it's shareholders equity, means you're doing accounting for a company, you'll see two accounts. First account called common stock. This is like the capital account, means the money invested by the owners. So for a sole trader, means when there's one owner and you're just a small shop, small business, then it's called capital account. If you're a company, it's called a common stock account, like it refers to the shares value, which is why the owners invest the money in the first place, right? So again, Capital, common stock, both mean the same thing. Both refer to the money owners invested into the business. The only difference is common stock is the money we received by the owners for the shares, and the capital is just the money that was directly given by the owner without any shares. So conceptually they are similar, but obviously like technically they are different things. Okay. Then the second account you'll see is something called retained earnings. Now we'll talk about retained earnings a little bit more in a while. First, let's complete the total equity. Oh, sorry. Here, yeah. Total equity, or rather, I should say shareholders' equity. And now we can combine the liabilities and equity to see if they match the total assets. If they do, that means you have solved it correctly. The accounting equation is holding true. Do you remember the accounting equation? Assets are always equal to liabilities plus equity. So now we'll combine the liabilities and shareholders equity value to see if it matches the asset. If it does, you have done everything correctly. You don't have anything to worry about. Now you might be wondering, like, how do I do the retained earnings? Don't worry about that. That is in our upcoming video on the statement of changes in equity, which is another financial statement. Hello everyone. So we are back to the course. As you can see, it's a new day for me. Yeah, let's dive right into it. So now we have already covered the statement of profit or loss, which is also called income statement. We also covered the balance sheet, which is also called statement of financial position. Now we are going to cover another financial statement, which is called statement of changes in equity. So statement of changes in equity. Now we already have had a brief discussion about what this financial statement shows us. So just to remind you, statement of changes in equity just shows you how the equity changed from the start of the accounting period, which is usually a year, to the end of the accounting period. So sometimes, you know, like we can see the balance sheet, of course, right? I can see at the end of the year balance sheet, this is my equity, right? And these are my balances. And I can also see last year's balance sheet as well. But what if I want to know how did it go from the last year's numbers in equity to this year's numbers? So that's where the statement of changes in equity comes into play, because we want to see the reasons it changed. So I will give you the format you should be familiar with. So we'll create the two accounts that we already talked about, common stock and retained earnings. Now in the general format, you also have this column of total, just to find do the total of the equity effect. Okay, now here you should write description. So we can write like what's going on. Why don't I put this here and maybe something like, oh, we can just delete this column. Delete. Okay, I see. Let me do it one other way. Okay, so let me first get this into this area. Now remove the column. Okay, finally, the most difficult part has been completed. Okay, so now let's get into the format. So I'll make it like a table so it looks clean and you know how you're supposed to make it as well. Okay, so I'll just separate out the different elements here. Awesome, looks pretty good now. So we have 4 columns. First one is called description, second is called common stock, again we talked about what that means. Third one is called retained earnings, and the final one is the total. So first we'll start with the beginning balances, means how much I had in each account at the start of this accounting period. So whatever that might be, you'll write there, and this is the total again, just to mention. Total means just combine both of them together to see the effect on the total equity, or what the total amount of equity was. Okay, then we will add issued shares. So we already established that when you issue shares, it goes into the account of common stock. I hope you remember. If you are a sole trader, means you are not a company, you are a single owner in the business, then you have a capital account. But if you're a company, you have the common stock account. Both accounts literally mean the same thing. It's just like difference of name, you know. So issued shares will go there. Again, if you're sole trader, just replace the name common stock with capital, and then instead of issued shares, just directly write investment by the owner, because in sole proprietor business, you don't have shares, right? Owners directly just put money into the business. So I keep saying that because in my experience, like that, these are the issues that people keep having, right? Okay, like what is the capital account, then why are we changing to common stock account? So you just have to understand the changes in the business. We are talking about sole proprietor in one case and a company in the other case, which we are doing right here. So we'll again show the effect in the total equity. Then we'll also add the net income from the income statement, and we have to add it to retained earnings. I hope you remember we talked about retained earnings. We said that retained earning is an account that represents all of the profits the company has generated from the start of the business until now that have not been paid to the owners. So what happens is, of course, you make the profit during the year, you increase the retained earnings balance with that amount of profit, and then you subtract how much you pay back to the owners, which is called dividends. And that's it. Now we'll find the ending balances, means what at the end of this accounting period the balances look like. And there you go. So this is called statement of changes in equity. I hope you can see we start with the beginning balances, which obviously are the ending from the last accounting period, right? Like what I had at the end of the last year is what I had at the start of this year, right? And then we like literally just went through what caused it to change. So if you issue shares, of course, common stock account will increase. And if you make a profit, then retained earning accounts will increase, because we said retained earning contains the profits of the company that it hasn't paid out to the owners. And then when you pay some of that money out to the owners as dividends, you subtract that money from the retained earnings to find the final balance of that account. And yeah, that's it. Now some of you might be wondering, okay, I am not learning statement of changes in equity. I'm learning directly statement of retained earnings. That doesn't really matter, because if you're only making statement of retained earnings, then just don't make this part, right? Only make this part, the retained earnings part. So let me just show you quickly what I mean by that. So if you are making statement of retained earnings only, means your teacher is trying to make it like a little bit easier for you. So I will copy the same format, except I will delete some, things about common stock, since we're just trying to find retained earnings, right? So we don't need the total column, of course. Since we are not having more than one account, we're just finding one account's balance, okay? And remove the common stock as well. There we go. Now remove the issued shares, because again, we're only this time finding the balance of retained earnings. So let me delete the two rows just to make it look more professional. There we go. So this is called statement of retained earnings, just in case you're wondering, like, I have not learned the statement of changes in equity. I've just learned statement of retained earnings. That's it. You literally just solve the part of retained earnings from the statement of changes in equity to get a statement of retained earnings. Yeah, I hope that is clear. And of course, like, I'll see you in the next video. So now that we have completed the discussion on the financial statements, now we have to talk about the next step in our accounting cycle, which is called closing entries. So let me mention that here, closing entries. So I hope so far you've been following along. So everything is like dependent on the previous thing, right? So we do this, like everything has to be sequential to get the accounting done. Now let me give you a brief introduction to like what are closing entries and why do we need to have the closing entries. So I'm going to start with a new sheet here. Okay. So far we have talked about 5 different categories of accounts. We have talked about assets, liabilities, equity, revenues, and expenses. So now that you understand like which accounts are asset, which accounts are liabilities, at least like have a good foundational idea, let's discuss another thing. So let's assume for a moment that you have a friend who has a business, right? Now if you ask your friend, like let's assume you ask your friend, what do you own? Your friend will tell you, okay, I own a laptop, I own a house, I own a car. Like, so that means when we are talking about assets, it doesn't really matter what time we're talking about, right? What I have is what I have. It doesn't relate to the time period. Okay. Same with the liabilities. If you ask your friend, what do you owe? Your friend will tell you, I have the bank loan that I owe to the bank. I have borrowed some money from this friend of mine. I owe him money. And like any of the liabilities work the same way. So when you have assets, liabilities, and similarly equity, because equity is just assets minus liabilities. So these three things are not dependent on time, means they don't end once the time period ends. Like for example, what I own this year will be exactly what I will have the next year, unless of course I sell it, but otherwise I will still have that. So these three are called permanent accounts. That's why, because they keep let's say going even if the accounting period ends. So these are called permanent accounts. Means again, these accounts will not be like restarted in the next accounting period to start counting from zero again. No, whatever I have this year, I'll continue counting from that number to whatever I do in the next accounting period. However, if you ask your friend, like, what was your revenue this year? Also, just let me just ask this way. If you ask your friend, what was your revenue? Now, here your friend will ask you, like, what do you mean? Do you mean how much revenue I made this year, this month, last 6 months? Like, for what time period do you want the revenue for? So we inherently know that revenues are related to a time period. Like, no one that you go to ask, like, what's your revenue? They will not really tell you the total revenue they generated from the start of the company 20 years back until now. No. When you're talking about revenue, it has to be related to a time period. Okay, this was my revenue in January, this was my revenue in February, or it can be yearly time period. This was my revenue in 2020, this was my revenue in 2021. So revenues inherently belong to a time period. We know that. Again, like if you ask your friend will never give you the or let's say your friend wouldn't give you the direct answer probably, because your friend will like wonder what time period revenue do you want to know about the business. Okay. Similarly, the expenses work the same way. So when you ask your friend, how much did you pay in rent? Okay. Now, again, we have to talk about time period. Okay. Do you mean like this month, last month, month before that? So just like that, every expense is also related to a time period. When you are talking about what was the expense, you can never just say the total expense. Like if you ask your friend what was how much rent did you pay, your friend will not really tell you the rent he has been paying from the start, like 5 years ago until now. No one does that, right? Your friend will not tell you the rent for a certain time period that you want to know about. So that's kind of where the revenues and expenses lie, and this is why these are called temporary accounts. Let's give it a separate color so it's easy to see. There we go. So these are called temporary accounts, means we need to close these accounts at the end of the accounting period. So next accounting period or next year, we can start counting from zero again to whatever number happens in the next year. So just to say that again, before saying that, let me also write this here for you. These are the accounts that need to be closed at the end of the accounting period. Again, we have been talking about that's usually a year, end of the accounting period, so that next accounting period, the counting of these accounts, the counting of balance in these accounts can start from zero. So I don't want these accounts to already have some money or numbers left over from what I made this year. I want to empty those accounts. So next year I can count the revenues and expenses for that accounting period separately. So there you go. So this is the logic behind temporary accounts and permanent accounts. Permanent accounts are accounts we cannot close because what I have this year is exactly what I'm going to have the next year. So it's not related to time period. What I owe this year, it's not like the year ends and now I don't owe the money anymore. No, you don't owe the money anymore once you pay it back. It doesn't relate to the time period. So I hope that part is clear. And now we are going to talk about the closing entries topic, like how we do that. So let's go to this adjusted trial balance that I've copied. Now the reason I have copied this trial balance because it includes a lot of accounts, and if I'm going to explain what closing entries are, I don't want to give you the easiest representation and then you find a complete question and you're confused. So here, yes, you'll see some accounts that you're not familiar with, but that doesn't really matter as long as we know what each account is. Like, is it an asset, liability, equity, and so on. So we are going to do now closing entries. Again, the purpose is to close all of the temporary accounts, so next year we can start counting from zero. We said there are two categories that are called temporary accounts, revenues and expenses. So let's close those accounts. And what do I mean by close those accounts? Again, closing accounts mean converting those accounts into zero. So let's see. First, we are going to try to close the revenue accounts. So let's see which revenue accounts do we have. Again, any account you see that you don't know about, ignore that. Don't worry about that, because obviously at this level that's not part of our discussion. Now people will make a mistake. People will think unearned service revenue is a revenue account, but if you remember from our previous classes in the adjusting entries topic, we said unearned revenue is a liability. You have to be very careful. So this is not actually revenue. There we go, service revenue. So now let's think about it. Service revenue has how much money in that account? $106,000 is the balance in the service revenue account. Now, if I want to make it zero, that of course means I need to decrease it by $106,000, so there's nothing left. And revenue, we already know the rules. They increase on credit, decrease on debit. So if I want to decrease it, I'll do service revenue debit by $106,000. Again, let's assume it's the yearly accounting period. So this will make at the end of the year at 31st of December. And any other revenue we have that we also need to remove? No. That seems to be the only revenue. And please remember, other side of the closing entry is always this account called income summary. So if I already have the debit, the credit will be income summary. Now you might say, what is income summary? To give you a way of thinking about this that's very easy, just think of income summary as the income statement. So what we did is we transferred the revenue amount to the income statement so we can calculate profit there, right? So we transferred the revenue here. Again, you don't need to worry about this reasoning. I always try to give extra, let's say, logical understanding. But again, if that does make sense, good for you. If that doesn't, that's not going to bother you ever in your accounting learning. So just remember, whatever one side of the entries, other side will be the income summary in closing entries. So next one, now we need to close the expense accounts. So let's see if we can spot some expenses. There we go. Salaries and wages expense. Okay. Now again we'll do the same reasoning, right? So since I want to decrease the expense accounts, means I want to convert them into zero, I will have to credit the expenses because they decrease on the credit side. So I'll do here salaries and wages expense credit, which is 46,000, and then we have supplies expense credit. Again, I'm crediting just to remove the amounts, so it becomes zero. Rent expense, we have 9,000. Then we have insurance expense amounting to 500. Then we have interest expense, which is 500 as well. Depreciation expense, which is 400. and last one, bad debt expense, which is 1600. So now that I've already removed all of the money from the expense account, what will be the debit side of the entry? Again, always the other side of the entry is income summary, and this time it will be the sum of all of the numbers, because again we know debits have to be equal to the credits. There you go. Let me also make there we go. So that's the range. So that's how we close the revenue accounts and expense accounts. Now there's a little bit more I need to show you here. So now let's think about it. Okay, so now I transferred all of the revenues into the income statement, means I transferred the balance in the accounts into the income statement. And obviously in the income statement we calculated the profit. And so now what we have to do is we have to close the income summary account itself, because first I increased the income summary account and then I decreased the income summary account. So to close the income summary account, we will obviously do it with the amount of the profit that was generated. So let's see, 31st of December, we will say, let's think about this logically. Okay, income summary increases on credit, decreases on debit. So how much money is in the income summary account? Let's see. I increased by this much, then I decreased by this much. That means the profit was 33,000. And again, we always close it with the profit number. I just want to show you the calculation you can quickly do from here. So 33,000 will be the amount. Okay, we understand that. But what will be debit, what will be credit? Let's think about it. Income summary, I need to close. So I need to debit income summary, since it has a credit balance. It has 106,000 minus 73,000 in the credit side. And what account will this transfer go to? Do you remember we said profit is always transferred to the retained earnings account? So we will increase the equity account called retained earnings by $33,000. So that's the third closing entry. Now we just have one more. Again, you might not have learned the last one that I'm about to show you, but if you have, this will be a good addition to our learning. This is just the last closing entry. You don't have to make anything else. You will not learn any other one. These are the only ones. Okay. Now, when you're making the fourth closing entry, you have to remember this fact that dividends account is a temporary account, even though it doesn't fall into our usual categories. It's not revenue, it's not expense, it's not asset, it's not liability, it's not equity. But just remember, at least for this part of your accounting journey, dividends is a temporary account. Means every year what dividends I pay, I have to count separately. So to close dividend account, if you notice, it already has a debit balance. So I need to credit it to remove that balance. So dividends will be credit. And if you remember the point, we said whenever you pay dividends, the money is taken out from the retained earnings account. So we'll decrease the retained earning account by only 5,000, because that's the amount of profit in the retained earning account that we are paying back to the owners. And that's it for the closing entries. Like I do understand that this is like a lot of things to think about, but that's the great thing about having a course, right? You can also like start the video and stop the video and watch it over and over again, solve the question with me, and see if you can master it. If you cannot, I will just recommend like you can reach out to me obviously here on or let's say whatever platform this course might be on. So yeah, so that's it for this video, and next video will continue in the last step of the accounting cycle called the post-closing trial balance. Let's talk about the post-closing trial balance, which is the last step in our accounting cycle. So if we go to our accounting cycle, this is where the post-closing trial balance takes place. So it's after the closing entries, we just prepare the post-closing trial balance, and then we're done with the accounting for that period of time. Okay, now let's get to the question. So if you notice, I've opened the same question that we solved for the closing entries, because of course post-closing trial balance is made after the closing entries for a reason, right? Because we need the closing entries to be able to make it. So I'm going to make the trial balance here on the right side, so it's like very easy to follow everything. I guess I need some more rows. Let's do that. Okay. So we'll name this one description, and then debit and credit. And of course, we are preparing the post-closing trial balance, so let's also give it a name. Post-closing trial balance. Now, just to give you a concept, this is basically post-closing trial balance basically is prepared to show what the trial balance looks like after we have closed all of the temporary accounts. Means, if I remove all of the temporary accounts, what will the numbers look like? What will be the remaining accounts that I have? So, in this case, cash will remain the same since it's not a temporary account. We did not close cash, it's an asset, and we just keep going this way. So it's like the easiest part of the accounting cycle. So you just like copy everything from the adjusted trial balance that if you're giving an exam you'll be provided, and yeah, that's all there is. Just keep mentioning the permanent accounts, which are assets, liabilities and equity, and if you find expenses and revenues, just ignore them, don't write them, right? Because we have closed it by now. We just closed these temporary accounts. Okay, so after supplies we have prepaid insurance 5,500, and then we have equipment. Okay, now if some accounts again, if some accounts don't look familiar, don't worry about it. We are doing this full question just so conceptually you are good. So like if you don't know what certain account means, ignore that, right? If you haven't covered in our course, not a problem. I'm just trying to show you a very good question of post-closing trial balance. So notes payable is 50,000. Okay, accounts payable, it is 25,000. Interest payable 500. Unearned service revenue, which is a liability account, of course, 8,000. And then salaries and wages payable, which amounts to 6,000. And then common stock, which is 100,000. Dividends, we already closed that. We discussed it's a temporary account. Service revenue, we discussed temporary account. All of these expenses we also discussed. These are temporary accounts, so I don't need to mention them. But there's one thing you need to remember. If you notice, we don't have the retained earnings account in this set of data. That means we can assume that retained earning is zero at this point before this accounting period. So if it was zero before this accounting period, which can be for many reasons, probably it's like this is the first year of the business, so they haven't made any profit before this accounting period. So no worries, we will write the retained earnings ourselves. And as we know, retained earning is the account that contains the profit that has not been paid to the shareholders. So let's think about what we did to retain earnings in our closing entries. So if you notice here, first we increased retained earning. How do I know it's an increase? Because it's equity account, it increases on the credit side. So if I increase it by 33,000, then I decreased it by 5,000 because I paid dividends, and when you pay dividends, your profit the retained profit that you have in the business obviously goes down because you just paid it out to other people. So it will be 33,000 increase minus 5,000 decrease to see how much we are left with. So let's see. There we go. Now we are done with the post-closing trial balance. Always do the total to see if the debit is equal to the credit. It should be equal if you've done it correctly. So let's see. Yes. So now this means we have solved our post-closing trial balance flawlessly. I hope you saw it's very easy. It's like literally just copy paste the adjusted trial balance and remove the temporary accounts. Like that's all we're doing, right? With the exception of course, in retained earning you have to like make a little bit of a difference. But everything else is like copy paste and remove the temporary accounts. That's all that is, right? So yeah, I hope the course has been very helpful to you. I tried to make it as easy as to the point as possible. I didn't include any extra things that you don't need to know just to make the course look fancy and so it has like so many hours. No, we stuck to the point. We made it tactical, right? That's the goal. Learn the things that you need to learn to become great, and ignore the things you don't need to learn, even though they might sound like some great important thing. So yeah, and I would like to say from the bottom of my heart, thank you so much for enrolling in this course. I really appreciate you staying in this journey with me, and hopefully you can after this course you'll also look over my other courses and see what I am providing, because I'll do the same approach, right? I'll keep everything to the point and exactly what you need. So thank you.